Its attention. Let's have a look at a number of assets heading into the market open. The pound then pretty much unchanged. We've got that GDP number as expected, the housing data, the calm before the storm perhaps there. The yen has been on the back foot today, went through 145. A little bit of verbal intervention from the Japanese finance minister brought it back a little higher. The US 2-year yield, that was the story really of yesterday. Yields going higher. It was that pulled yields a little higher in the European session as well, arguably. Or was it the more domestically generated dynamics? What do you see then, Tom, in the futures picture?
I love that you touched on the yields. Valerie Teitel from our markets team saying that they scorched higher yesterday, double digits in terms of the BPS, at least in terms of the yield move higher at the front end. The DAX futures pointing to gains of 3/10. FTSE 100 futures up by 19 points, back above 7,500. Over in France, gains of 29 points. Anna.
Okay, so the futures picture pointing higher, decisively so, would you say, or modestly so, perhaps would be the right descriptor for that. So we are expecting a few tenths of a percent higher for European equity markets. We'll see if we get that. The FTSE 100 then first out of the gates and pretty flat this morning. The Spanish IBEX up by 0.3%. We're thinking about the US strength of yesterday. We saw that in some places in the US markets yesterday. Certainly strength in the data that lifted yields. To some degree it lifted stocks, although we weren't overly ebullient by the end of the session. We've got the Australian dollar up by 0.2%. The euro pretty flat. The pound pretty flat, despite the fact we got confirmation, or maybe because of that confirmation of lackluster growth in the first quarter. And then we also got a nationwide housing data, which suggested some calmness, just as the mortgage market data of yesterday did. But of course, we're storing up the turmoil there, perhaps. In terms of the yield story, and that's clear to see, we're continuing that yield story of yesterday. So we see the US 2-year yield up by another 3.6 basis points, the UK 30-year, the Australian market jumping, Germany, Switzerland, Spain. So we've had the French data out in terms of inflation, but perhaps it's this global dynamic, thinking about higher rates for longer on a global context, perhaps then, Tom. What do you see in the sector breakdown?
Well, standing out for me, and this is interesting in the context of that softer than expected data out of China, or at least confirmation that that economy continues to slow. Basic resources up 7%. The downside, three main sectors that stand out for us. Technology getting a drop of 0.8%, so the yield move higher is obviously a pain point for the tech sector. And we had a bit of a sell-off in some of the big US tech names yesterday on Wall Street. Retail also off by 0.4%, and consumer products essentially flat. So three main sectors in the red, but it's basic resources and energy up 0.9% that are leading the drive higher.
Okay, and sometimes that does play well for London. Let's talk about the divergence between the London market and some of the others. We'll delve deeper into the markets with Sophia Horta-Acosta from our Markets Today blog, who joins us once again. And Sophia, you've been looking at the underperformance then of the FTSE year to date versus some of the other markets. I mean, it's certainly not Japan, is it? The FTSE pretty flat, actually going nowhere year to date.
Yeah, exactly, and actually that divergence has really accelerated in the second quarter, which is quite interesting. I mean, obviously the FTSE is very highly geared to the China growth story because we do have that heavy mining segment as well. There isn't really anything to drive the UK stocks higher, and it's that underperformance is also feeding through to the FTSE 250. That's the UK kind of more domestic stocks, I should say. So that whether that underperformance continues, for me, that's a big story going into the third quarter. Also, where are the positions kind of really concentrated there? Everyone is so bearish on the China growth story. Are people too bearish on miners? Are people too bearish on commodities? That would be, for me, looking at the outlook for UK equities.
And there isn't necessarily a very obvious expression of AI optimism or tech optimism when it comes to the UK markets, is there? And that also often sort of weighs on the UK.
It's difficult to find a clear play on that front, at least for now. It's interesting in terms of business sentiment. I mean, we're thinking about the next catalyst for these markets maybe being the earnings picture. Business sentiment, though, in some areas is still holding up fairly well.
Yeah, the data, it's bizarre because the economic data in the UK, business sentiment is holding up. Lloyd's survey showed, house prices are actually okay, or at least they're not falling as expected. GDP was relatively okay. Everything is relatively okay. We're not really seeing that in markets. The FTSE is obviously not a reflection of the UK economy, but how to express that view? Where are the bulls? The bulls right now, they're very much on the other side of the pond in the US. They're very, very bearish on China growth. They're very bullish on Japanese equity. So that story, whether those kind of very, very concentrated positions whether we'll get a shift around in the third quarter, that could kind of be a play for the UK market as well.
For the UK market, and broadly, I mean, that big discussion over in the US about the concentration, the narrowness of the market, with the focus, just as Anna was saying, around AI and the big tech names, the broadening out of that market, how consequential do you think that will be, just in terms of global sentiment, to be shifting away and shifting to broader parts of that equity market?
Yeah, that's the danger, right? When only a handful of stocks are lifting the market, and then when that gets a kind of a turnaround, that we see the kind of drops that we saw last year in US tech. I mean, a broadening of a market, a broadening of a rally is always good. When you look at a portfolio, an index like the S&P 500, if you're seeing more.
For a moment, we're just getting some headlines coming across the Bloomberg around ASML, which of course is the Dutch ultraviolet lithography machine maker, so it makes the equipment that makes the chips. And we are getting confirmation of a story elsewhere that have been picked up, though Bloomberg has been covering it in recent weeks as well. The Netherlands to introduce new chip gear export restrictions. The Dutch additional chip gear export limits apply from September the 1st. And we were hearing from our colleague Joe a little while ago that this is because they contain parts that are made in the US, and that's part of the reason that the US can exert some pressure in terms of the geopolitically influenced export policy that they want to apply here.
And that kit, that US kit, goes into building these huge, incredibly expensive ultraviolet lithography machines, the size of a bus, that are then shipped all around the world to places like China and to TSMC in Taiwan. Currently, ASML is down 2.5% on the back of this news. We knew it was probably coming, but there is a price move there on the back of ASML. So the tightening of the grip, as you say, around these important parts of the chip and semiconductor ecosystem, again, as US tries to constrain that.
Yeah, we'll get you that move in the ASML share price. Sophia, thank you very much. Sophia Halter-Acosta from our Markets Today blog. Down more than 2% on that ASML share price, as Tom was saying. You can get more from the blog team, front page of the Bloomberg UK website. That's where you'll find it, or by typing TLIV GO onto the Bloomberg terminal. Now let's take a look at a few of the things that markets are watching out for today. At 10 a.m. UK time, we'll get a preliminary print on Euro area CPI for June. The French figure for the same period came in around half an hour ago. We got a little underwhelming, perhaps, on the French data. Also today, it's the end of LIBOR, the last dollar LIBOR fix. That occurs at 11:55 a.m. UK time, and boy, has it been a long time going. Later, it's been around for 50 years. Took 10 years to disappear, though. Later, it's over to the US, where we get that PCE data, the Fed's favorite measure of inflation. That's at 1:30 UK time. And at 3 p.m. UK time, the latest University of Michigan sentiment survey will be released. There's actually quite a lot. It's a fairly quiet session, really, here in Europe, but a lot of data coming through. That inflation print for Europe will be crucial.
The inflation print is going to be crucial. And again, we heard officials from the ECB keeping the door open to September. Does it move in that direction, whether it opens that up or locks it in? In terms of the US data, again, just really being reminded this week of the strength coming through for the US economy with that jobless claims print. And then it's, again, the favored inflation indicator coming out for the Fed later today after the relatively hawkish comments we heard from Jay Powell as he toured Europe this week. By the way, your futures in the US are pointing to gains on the NASDAQ of about 0.2%. Now, as US data surprises to the upside, the Fed's Raphael Bostic, now the dove in the camp, says there is time for us to wait and let policy work. We discuss that next, and whether the PCE indicator is going to give him some support in that view. He's a bit of an outlier at this point. Stay with us. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
This is Markets Today, 10 minutes into the European equity trading session, and we have modest gains across European equity markets, up around 0.4%. That's certainly what we've managed to achieve on the Stocks Europe 600.
Let's go a bit deeper then, dive deeper into some of the individual names on the move with Joe Easton with the Stocks to Watch. Joe.
Absolutely, Tom. So we're going to come and have a look at some of those stocks that we mentioned in Stocks to Watch just a moment ago. We've got Adidas and JD Sports both dropping following that report from Nike that sent the US clothing company lower in after-hours trading. That's hitting those stocks, with JD being one of the biggest retail partners for Nike here in the UK and in the US as well. Meanwhile, ASML, we've got some more headlines coming through, as Anna mentioned, regarding the Dutch government's potential restrictions on sales to China. We had the Reuters report overnight on the US potentially limiting sales of ASML machines to some Chinese factories as well. Meanwhile, ENGIE gaining around 1.4% in France as they raised their earnings guidance, citing a normalization of market conditions. So thankfully, all of those stocks moving in the right direction for me this morning. We're also going to have a look at a couple of UK home builders. We had some nationwide house price data coming out. Now, the monthly number, slightly better than expected. We've seen a small increase in UK house prices, according to Nationwide, and that has increased the shares of Persimmon and Berkeley a bit today, the biggest UK home builders. Those are getting a boost. Meanwhile, Casino, that stock slumped 38% yesterday as shareholders faced potential wipeout due to a restructuring of the retail and food company over in Paris. Down another 5% today, a bad couple of days for that stock indeed. Meanwhile, also in France, we got Sodexo, the catering company. Now, the headlines on this earnings, better than expected. The margin's better, the profit better. I'm not sure why that stock is dropping. I'll have to dig into the analyst reports, but that one is underperforming quite surprisingly in Paris today.
Joe, thanks very much. Joe Easton from our equities team with the latest on some of the stocks on the move this morning. Let's talk about what's going on with the Fed then, Tom.
Yeah, from the micro to the macro then, the Fed's Raphael Bostic has reiterated that he favours keeping rates on hold, but that Chair Jerome Powell and other colleagues, well, they don't agree with him.
I think it's wise that we take some time to assess how monetary policy tightening is affecting the economy. Because in my view, policy has been truly restrictive for only 8 or 9 months. It is less certain that we need to keep hiking the policy interest rate in the immediate term, lest we risk tightening too much and draining too much momentum from the economy.
Let's bring in Stephanie Niven now, portfolio manager at 91. Stephanie, as you look across your portfolio, are you weighing the words of Raphael Bostic? Is that what you think is going to play out? They're going to hold? Or we saw the data yesterday. just re-emphasizing, again, the strength, the resilience of the US economy. What are you starting to think about, essentially, as you pull in all these comments and this data in terms of where the Fed goes and for how long they're going to leave these rates at these elevated levels?
Sure. Well, we continue to see the Fed as one of the most credible central banks out there at the moment, and we think that they will
regain that credibility?
We think so, yes, very much. So they continue to be data-led. We continue to see them react and respond to the, increasing news flow that's happening out there in the economy right now. And we think that they will get this job done. So we most recently called for them to have a skip in rates, and that came through 2 weeks ago. And we think, they will double down, and we do think that they will continue to focus in on that inflation number. And, the comments that we just heard, that is very clear. We are seeing that delayed impact. And that's something that, perhaps isn't all that surprising given where we came from, how low rates were when we began this historic hiking cycle, and effectively the change that we've seen in the leverage on the consumer base as well.
Good morning to you, Stephanie. Does the better data out of the US take us into smaller caps in terms of our US stock preference? Because we've seen obviously a lot of strength we're sitting here at the half-year mark, a lot of strength in technology, a lot of strength in the big caps, real underperformance from the Russell 2000, up by 7% year to date, versus the NASDAQ up by 30%. On a couple of days this week, when we've had positivity and risk on sentiment in the US, that has led people into smaller caps. Is that a theme to come?
Sure. I think we're actually going to see a rotation into those names that have more sense of control of their own destiny. So we're looking for those businesses that have sustainability-driven structural growth elements to them, those businesses that can grow through macro, volatility. And you're right, we continue to see this, recession or slowdown being pushed out, but we're pretty clear it's going to come, and we need to be investing in those businesses that can weather that experience.
In which sectors are you finding that resilience?
So we are looking in the tech sector, and we're looking in the semi-cap sector, but we're looking, beyond just the kind of overall hood, and we just need to really drill down and understand the different business models that are out there. So we're in some of the semi-cap equipment names, those businesses that can provide the picks and shovels to this AI transition that we're seeing. And, what an exciting time to be a fundamental investor and be able to back those businesses that can help that transition come forward, really change that narrative in the tech sector, and really think about decarbonising the journey that we will be going on in that area.
Yes, thinking about the decarbonising, I know that the Inflation Reduction Act in the US, it's big by a lot of people's description, and it is going to have a big impact. Do you bet on businesses that are going to benefit from that very specifically?
Sure, we see that as a really exciting element of structural growth that will come through and will benefit the US economy for a number of years to come.
And is that through the cycle, sort of away from the cycle?
Yeah, we see that very much as decoupled from some of the macro volatility that, we would definitely see into, the next 18 months. And we are backing businesses, like waste management that benefit from tax credits associated with biogas. We're backing businesses like Train Technology that really have that incentive structure to deliver heat pumps and more energy efficient names. But, we can look across the globe and we can see broader, manifestations of energy management, efficiency, decarbonisation coming through in businesses like Schneider Electric in Europe. So there are a real variety of ways in which we can play this trend. And, we've been really excited to see the progress that we've seen so far.
The FTSE 100 has underperformed year to date. Sure. Is there anything attractive in UK equities that may compel you?
Well, the UK is a tough space, and, the Bank of England have been slightly slower than perhaps we would have liked to have seen to respond to data. They've been very much, focused on models rather than responding to.
Have they lost their credibility?
Well, let's see how they begin to kind of double down on the messaging. But, there's still time to pull it back. But we do need businesses that can either sort of work towards providing better healthcare outcomes or work towards decarbonising that kind of ingredient chain within the luxury consumer products.
And we were talking earlier about how maybe there isn't such an obvious UK expression of the AI theme. Is there? Have you found one, Stephanie? Do you bet on things in the UK as a result of that theme or elsewhere?
We're still looking, but one thing we have been looking at is RELX, and that's quite interesting because as you see AI develop, our view is that some of the winners will be those who have proprietary data sets. And if you look at RELX, if you look at their LexisNexis business, that looks to us to be a proprietary data set where we could see really compelling value come through as RELX continues to help its customers.
As long as they can sort of monetize that with AI.
Yeah, and I think that's the thing we're all going to have to learn as investors, to understand that nature of the data sets, to understand, which elements of AI will become commoditized. But, this is a tectonic shift. And this is a really exciting area. And I think, the UK does have potential to grow into this space, but we're just going to have to see how this this plays out. And, you know, let's not forget we're only 100+ days into this, you know, real transition in AI. Is this generative, this ability to create content that's really so fascinating about the news flow.
I guess the challenge is kind of cutting through the noise. There's a lot of noise, cutting through the noise and to kind of focus on some of the fundamentals. Bloomberg's been doing a lot of reporting in terms of the competition between China and the US on the AI question. Is there anything in China that looks attractive?
So, I mean, the Chinese economy is very challenging at the moment. You know, we have a lot of internal debates about this. It's, you know, really interesting to see how it transitions from being investment-led to consumption-led and all the different bumps and policy inflections that we will see on the way.
They've got those AI themes. They've got the sustainability theme. You follow the policy, would be an argument.
Sure. One of the areas we're really interested in is the financial inclusion element. So how China looks to build out some of those financial safety nets, the insurance, the accident, the property, all of those safety nets. That's an area of, you know, really fascinating kind of investment exposure that we have in our portfolios. And, you know, it's all about kind of going stock by stock and being a fundamental, you know, analyst and really thinking about all the different nuances of the business models out there.
Okay, so some of that insurance provision and growth of that, interesting. Stephanie, thank you very much. Stephanie Niven, Portfolio Manager at 91. Coming up on the programme, Adidas and Puma shares slip as Nike's annual outlook failed to win over investors. More on that next. This is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Can you believe it's summer already? That means it's time for the Boston Pops Fireworks Spectacular, and Bloomberg will make sure you see all the fireworks, music, and special appearances by pop superstars En Vogue, chart-topping country duo Low Cash, and film, TV, and Broadway powerhouse Mandy Gonzalez, plus the U.S. Army Field Band and the cast of the Broadway musical Ragtime. It all starts July 4th at 8 p.m. Eastern, right here on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Markets Today, 23 minutes into your European trading day. Happy Friday, end of the first quarter, closing in on the end of the first half. And you're seeing gains across European equities, a little pop actually in the last few minutes, getting 0.4% across the benchmark. The sector that is at the top of the list right now in terms of those gains, real estate up 1.7%. Bottom of the list, tech taking a bit of a dive lower. The dive is a bit of a stretch, but certainly lower by 0.8% for tech. The loss leader across these sectors. Again, real estate at the top of the list, getting 1.7%. Anna.
Okay, let's get to a consumer story that is of interest. Adidas and Puma shares both were slipping, now a little divergent, either side of the flat line this morning. After we saw Nike's outlook fail to win over investors, the sportswear giant expects full-year revenue to fiscal 2024 to grow in the mid-single digits. Joining us now for more is Bloomberg's consumer goods reporter, Dasha Afanasieva, who's with us on set here in London. Dasha, very good morning to you. So what were the key takeaways then from these Nike earnings? Because they do often influence this side of the pond as well.
Absolutely. So Nike actually beat revenue estimates for the quarter, but I guess the market wasn't impressed because as you said, the revenue outlook for 2024 was quite conservative. Now, on the analyst call, the CEO was asked about this, and John Donahoe said that he spelt out quite a sort of pessimistic, arguably, view of the market, which is that there's still a lot of promotional activity. There are concerns about the strength of the consumer. And I guess that's truest for its more mature markets, North America and Europe.
So it's the concern around potential margin squeeze, isn't it? And that links us to the inventory story. They've had to work through this pile of inventories that they built up. How much progress have they made on that front?
Absolutely. So there wasn't too much progress on that in the last quarter. And the inventory was broadly flat, but there was a sense that there's going to be more promotional activity, more discounts, because that's just the market that they're operating in. And the other aspect to the margin contraction was things like freight costs.
Right, okay, that's interesting. Let me ask you about the Greater China market for them. Clearly a big market for anybody who makes this kind of leisure wear. How did the company perform there?
So this was actually really positive. Revenue rose 16%. And this year had a lot of positive things to say about the digitization of the market and the strength of that consumer. So that was a lot more upbeat. And there are other things to look forward to. The company said that it's relaunching its Kobe Bryant apparel and trainers line. So and is excited about the Paris Olympics.
Okay, Dasha, thank you very much for that. Dasha Afanasieva with the latest on those consumer giants. Let's get to the broad markets picture then. On the 30th of June, as we are, Tom, we're at the midway point, aren't we? Halfway through the year. Phew. We've actually seen quite a lot of stock gains, given the concerns around the Fed and in the inflation outlook, given the concerns about the US recession possibility. We've seen gains across the globe, really, for stocks, but in particular over in Japan. Just wanted to highlight that year-to-date performance on the Nikkei 225. Although I will point to some data that just came out from the Ministry of Finance that said in the most recent period, foreign investment in Japanese stocks decreased for the first time since March. But I guess if you're 27% up year-to-date, then maybe that's enough.
And look at that divergence when it comes to the tech story. And Sophia Horta-Acosta was outlining this for us. The China tech story, indicated by HS Tech, down 5% year-to-date. The Nasdaq, of course, rip-roaring, close to 40% gains year-to-date. That story, and if that plays out into the second half, is going to be really fascinating.
So something certainly to watch. Coming up, the ECB is facing a dilemma with divergent inflation data from the euro area economies. We'll get the official Eurozone as a whole print later. The focus will be on that core number. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because like when you invest, and you know this, when you're investing, you can control a lot more things. When on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling, because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like, just the joy that you had brought to the city was phenomenal.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Markets Today. We're 30 minutes into your European trading day. Here are your top headlines. Strong US data prompts traders to bet on 2 more Fed rate hikes this year. Global bond yields rise. The yen breaks 145 per dollar. French inflation follows Italy and Spain down to a 14-month low, signaling the ECB is making progress in its battle to ease price pressures. Key US inflation figures also hit later today. Plus, ASML shares tumble on a report the US is planning to force the chip equipment maker to ship fewer of its machines to China. So, Tom, we've got a bit of geopolitics in the mix there. We've got plenty on the macro front. The inflation data out of the Eurozone due shortly, and the PCE indicator out of the US later.
And the high yield environment, it's not constraining equities at this point. Once again, it's a narrative we've seen, of course, year to date, with the global equity markets posting double-digit gains, at least so far. As we close out the first quarter, close out the first half, you're looking at the benchmark European stocks since 600. It's a Friday, I'll get there, up 0.4%. The DAX is adding 57 points over in Germany, and the FTSE 100 just below that 7,500 level. GDP came in essentially in line with estimates here in the UK. Gains of 0.2%. Of course, the strength of the US economy continuing to play into investor expectations around the Fed, where the Fed goes, and that inflation data out later today, of course, consequential on that front. On the sector basis, let's flip it over and see where the gains are coming through and where the pressure is being felt. We talked about the DAX posting some pretty decent gains so far in the session. Auto sector, of course, is consequential there. Gains of 0.4%. Banking sector is also up 0.6%. You're seeing some gains for financial services, food, energy above more than 1%, despite the softness in that China data. And again, the divergent pictures now between the economies of the US and China. Basic resources getting 0.9%. Just in the red is technology, off by 1%. You saw some selling of the mega cap tech names over in the US yesterday. Is that AI theme? Is it starting to run its course? Bit of profit taking here, a little bit of pressure so far in the session on European tech, Anna.
Yeah, and no surprises that ASML and ASMI International are the worst performing on that tech sector in Europe. Now, inflation re-accelerated in Germany, but drastically slowed in Spain, showing evidence of the uneven progress that's keeping the ECB focused on further monetary tightening. Eurogroup President Pascal Donohoe said he's confident that the central bank is striking the right balance.
We are focused on getting to a place in which we get inflation down and that we can still support growth within our economies. I'm confident that we are still able to do that. And that confidence is underpinned by the record levels of employment that we still have and by consumer sentiment that continues to be positive.
Joining us now is Stefan Schneider, Chief German Economist over at Deutsche Bank. Stefan, welcome to the programme this Friday. Thanks for being with us. So if I could start with the German story, and I know we'll talk about the Eurozone story as well, but the German inflation rate ticking upwards. We saw it across all the different regions of Germany coming through yesterday, and then it ticked upwards in the overall national level. I wonder, is this all to do with cheap train tickets a year ago and other sort of idiosyncratic factors? I ask this because when we get to the Eurozone core story, that is also expected to tick up.
Yeah, good morning, Anna. You are right. Actually, the increase we saw in the year-over-year rate up to 6.4 from 6.1 is largely due to the basis effects from the kind of subsidies for petrol and cheap train tickets we saw a year ago, and that will basically stay with us for 3 months. And only in autumn we'll see the year-over-year rate coming down further.
Where does it, Stefan, where does it leave your kind of final forecast for the end of the year for German inflation?
4-ish, probably slightly above 4%, with this basis effects bringing inflation down. But I mean, what we see, for example, in German inflation data, but also in some other countries, is that, yeah, the easy part of the fight against inflation is basically almost over. I mean, we see strong base effects from energy pulling the inflation lower. We see that the price pressures we saw from the supply chain issues are coming down. But at the other hand, we see that core inflation is running strong and partly beating expectations because of higher wages and the pass-through into the later stages of the production. So in this respect, I think there are two pictures now.
Right. Let me ask you about the wage picture and, of course, the tightness of the labour market in Germany. We talk about it in the US, we talk about it in the UK and across Europe, tight labour markets. What's the German explanation for this? I stand here in the UK and we can look to the sort of long effects of COVID taking people out of the workforce. We can look to the healthcare service and the delays there. Some, although not the Bank of England governor, referencing Brexit. What is it that makes the German labour market tight at this point?
I think actually the German labor market has been tight for quite some time. And the surprise in the last 1.5, 2 years was that, you know, it was not just Germany. We saw tightness in the rest of Europe as well. But I mean, in Germany, obviously demographics and the baby boomers retiring is a major factor. And we have, I mean, we used to have a shortage of skilled labor, but now it's basically a shortage of labor, full stop. And that's something which obviously plays into the hands of the unions and which will basically give them power to basically claw back some of the real income losses they have experienced in the last 2 years. And that's one reason why we expect that wages will remain high going into next year.
Stefan, does that mean, and we've heard from ECB officials, Luis de Guindos saying that July is fait accompli for the ECB. Is September, do you expect that to be locked in as well for the European Central Bank, given those wage pressures? We're at 3.5 now. Do we get to 4% by the end of the year?
I mean, as the central bankers are saying, it's completely data dependent. And I think, you know, that's the right approach. I mean, we have seen that the forecast, whether the private sector forecast or the forecast of the central banks further out, let's say for the next 12, 24 months, have been misleading. So I think it would be too dangerous to basically make that predictions dependent on actual forecasts. You have to see how the data comes in. And I think central banks are right. And central banks in the world basically are all following the same approach here. So to answer the question, September is completely open. It's not our base forecast right now, but actually it depends on the data, even for our forecast.
Okay. So September is open. Many ECB officials telling us that they have decided they'll hike in July, but you're right that they also talk about being data dependent. On the data side, you pointed to the divergence that we've seen between manufacturing being weaker after playing that catch-up supply chain race, and then on the services side, things being really strong, and the tourism dynamic being really strong this year. Stefan, are there any precedents for understanding this divergence across Europe?
I think it's a divergence across Europe, which partly has to do with the fact that in some countries we have basically government interventions to bring inflation down. So that's part of the story. But you're alluding to the sectorial divergence. And here, obviously, we have the aspect that the global economy is not doing that well. That keeps the industrial sector basically at bay. At the same time, we still have catch-up demand post-COVID, which accelerates the services sector. And plus, the wages we talked about, they play a much bigger role in services. Around 40% of the costs in services are wages, compared to around 20% in the industrial sector. So this wage pressure shows up in services much more.
How much more catch-up is there, though, Stefan, that you flagged there, and what does that do for your growth outlook for the region?
Actually, I think we are more or less peak catch up right now, so to say. I mean, if you look at the consumer confidence surveys in Germany, it came down a little bit. The income expectations have lowered. So we think this is basically running out of steam, which is partly also the reason why we as a house are pretty skeptical for the German economy. We are forecasting -0.3 this year GDP growth, and also for the Eurozone economy, we just see 0.5. So this will probably, to a certain extent, make the ECB's job somewhat easier. That's the reason why we don't expect a rate hike in September, but it's basically weak demand. But then we have these structural supply issues like the tight labor markets, which basically still keep inflation relatively elevated.
Really interesting context. Stefan Schneider, thank you very much indeed. Chief German economist at Deutsche Bank, on the view there that at least for now, September is unlikely for the ECB, but of course the data will be consequential, and the view that catch-up post-pandemic has peaked, at least it seems, according to consumer data. Thank you. Now, the failed mutiny, switching focus, the failed mutiny by the Wagner mercenary group has put President Vladimir Putin's authority in the spotlight. Bloomberg TV's Francine Lacqua asks what consequences this could have on stability inside the world's biggest nuclear power.
Over 24 hours, Russian President Vladimir Putin faced the biggest threat to his almost quarter-century rule. The uprising has raised questions about Putin's grip on power. The influence
move again unhindered with speed towards Moscow. I think there may have been an expectation that he would gain further support from Russian soldiers, and that maybe this would spark protests in other Russian cities. And I think that may have played into the fact that he decided to turn back.
These events have thrown Russia's internal security into question, a worrying prospect for NATO given its nuclear arsenal. After 16 months with little success on the battlefield, and now a Ukrainian counteroffensive followed by the mutiny of his own forces, Putin's future may be in doubt.
You can imagine there'll be lots of conversations going on behind the scenes amongst the elite in the business and the military establishment about whether to continue to support Vladimir Putin into re-election next year.
Well, many people think that this is good for Ukraine's counteroffensive, that it shows a sign of weakness. There have been some reports that Ukrainian forces have made incremental territorial gains, but it's really unclear at this point. The alternative view is that actually, because of the weakness and the turmoil in Russia, that the Russian Defense Ministry and the Kremlin will decide to strike back even harder and do something out of the ordinary to distract from the domestic political struggles.
Our colleagues there reporting on the latest out of Russia. To watch the full report, go to Bloomberg Quick Take on Bloomberg.com and on YouTube. Coming up in the programme, UK living standards came under fresh pressure in the first quarter with lacklustre data out this morning. We'll break down those numbers next. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
This is Markets Today. We are 45 minutes into the European trading day, and the futures picture looks broadly positive, up around 0.4% on the Stock 600 this morning, this Friday. The end of the month, the end of the quarter, the end of the half year then, Tom, from a markets perspective.
On the macro data, UK GDP, it broke at 7 o'clock. Someone who has very firm views of this, we're getting his views very shortly. Marcus Ashworth, of course. UK data grinding out, I like that phrase, gains this morning. First quarter GDP growth came in as expected at 0.1%. And the housing market showed surprising resilience, at least for now. Prices fell by 3.5% year on year, less than expected. Bloomberg Opinion's Marcus Ashworth, he's always had a bit of a problem with the perma bears on the UK economy. Marcus, how does this inform your view of the health or lack of health of this UK economy?
We're talking about polar bears. There's no doubt about it. Any form of progress or downward movement is glacial. And I think quarter one is important to note that those savings were taken out and a bunch of business investment moved across. A lot of this was sort of rearranging the deck chest, should we say, with regards to the dropping off of tax allowances for corporates. And indeed, it's still a very high savings rate, but people using their savings because the pinch was certainly on. Some of that pinch will improve quarter two. But what's sort of perhaps better news for the consumer, and wages are clearly still very strong, is actually bad news for the Bank of England and what the Bank of England is trying to achieve. So the Bank of England will probably have thought, well, those quarter one numbers weren't too bad, but they'll be thinking quarter two is still worse in the sense of inflation is still very sticky. It was not having an impact on the consumer quite yet. And likewise, labour market stuff is still so strong. And that's why they had to hike 50 basis points last week. So unfortunately for them, they'll look back at quarter one wistfully in some ways and think, well, we know there's going to be more help coming for the consumer quarter two.
Right, yes, and thinking about what households have done with savings and what lies in store on mortgages is interesting when you look ahead to the second half of the year, isn't it, Marcus? Because today we got that number, as you've referenced, what they've been doing with savings, households drawing down savings to cut mortgage debt at a record rate. People see what's coming on the mortgage side.
Absolutely, and I think this is why we're at danger of perhaps whipping up a storm on the mortgage market when it's not really going to react very much. Banks still very much want to lend. You can see that in the spread they charge for, say, tracker rates above the Bank of England base rate. Indeed, what they charge for higher loan-to-value mortgages. They are keen to lend. They're not going to get caught out by sharp rate moves, as we saw in both September, October, and then again, obviously, last month when the CPI and labour data was so bad and the market moved over 100 basis points. They are going to move away from that. But things will calm down. What the Bank of England did with their 50 basis point hike was, in fact, just move up to where market levels were. If you remember, actual fact, gilt yields fell on the day. So the mortgage market should take some comfort. Bailey's been very careful to say that what they do on August 3, they will make their minds up. People expect another hike, and that's probably the right way of looking at it. But there is some help slowly going to come through on inflation, and we know labour market is strong. So far as the consumer is concerned, if you can afford to have a mortgage and to take out a mortgage, you are still getting a reasonable pay rise pro rata to inflation, which will steadily, at some point, we hope, drop below where wage raises are, and we will catch back up that cost of living crisis. Savings levels are still very high. courtesy of the pandemic. So this is just consumers moving out of the way and trying to reduce their debts if they can. And really, unfortunately, we will see some improvement. Bear in mind, as one of your guests earlier said, a lot of the European governments essentially put it all on their debt and made their inflation look optically lower than it really was. The UK, for whatever reason, we have our own system, and the ONS is their own way of calculating it. We're doing it differently. It's taking much longer to pass through, but it will pass through by the end of the year, and the Bank of England knows that.
And gilt yields moving higher again in the session today. At the front end, the 2-year at 5.3. Marcus, you don't see it's because he's painting this rather benign picture of the UK that not everyone shares. But I respect it, Marcus. You've also got views on LIBOR. It's finally, I thought it would be, honestly, I thought it ended a while ago. It's ending today, Marcus. Are you going to be shedding a tear?
A little bit of a tear. It ended for sterling quite some while ago. I mean, the simplest way of putting it is the UK authorities blessed them, rammed it through, and everyone else watched and waited to see how much destruction they would cause in the money markets. The answer is that they probably went about it, they could have done it a little bit more elegantly, but they probably went about it efficiently in the cash markets. The futures markets, where probably most of the volume trades, not so much success, unfortunately. The liquidity in the SONIA futures is nothing like what it was in short sterling, and that's an issue. One of the reasons why we're seeing yields spike so high, particularly in forward rate markets, is because there is not much liquidity when people need a hedge. Anyways, the US have done it better on the futures side, and now they're finally getting their act sort of together on the cash side, even though a lot of the regional market and a lot of the legalities have yet to really being switched across to what they call SOFR. They're all calculated differently, all got different names. LIBOR was at least simple, and LIBOR allowed you to have a credit spread to understand the risk you're taking and to borrow more easily, I think, in longer terms, 3 months, 6 months, even a year. And I don't think SONIA or SOFR, or what you want to call it in dollars, unfortunately gives you that luxury.
Marcus, thank you very much. Bloomberg Opinions, Marcus Ashworth talking to us about the UK economy and the LIBOR story as it ends after 50 years. Let me get to another story we're following this morning. ASML, the maker of the machinery that makes chips, it's been caught up in the geopolitics between the US and China, of course. We had earlier reports that suggested their ability to export to China would be crimped. That has been confirmed this morning, but ASML pushing back on this being something that has a real impact on the business, saying that the new Dutch measures won't have a material impact on the outlook. They say the new controls concern one particular model and subsequent models. Shipments of other systems are not controlled by the government. They will comply with all Dutch, US and EU export regulations, they reiterate. Coming up on the programme, we'll talk about bond markets. Allianz warns its giant bond manager, PIMCO, is struggling to attract new money. This, as we could see, a continuation of yesterday's theme, driven by strong data, yields going higher. We'll get more on this. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO. I have a problem. I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Welcome back. Allianz is looking to push deeper into alternative asset classes as its giant bond manager, PIMCO, struggles to attract new money. Let's bring in none other than Danny Berger. Danny, PIMCO's DNA is obviously in bonds, and it's not going too well for them.
No, I mean, look, they're moving to alternative assets, or at least they're shifting the focus more towards that. It's something that would absolutely make Bill Gross very angry if he was still at PIMCO. But look, it's twofold the reason for this. One, it's industry dynamics. The other is market dynamics, as we talk about all the time. Last year was horrible for bonds. PIMCO saw 75 billion euros worth of outflows from their products because of that. Yes, the first quarter has picked up a little bit, but in conversation with our Bloomberg reporter in Frankfurt, Stephen Call, the CEO, Oliver Bete, basically saying investors are still skittish. On the industry side, they have a lot of active funds. You can go out and buy a cheap passive ETF right now on bonds. So on this, he said, again, to our Stephen Call, that everyone assumes that bond flows have to come back once we hit a peak in interest rates. But the question is, how much of it will go into passive strategies and what goes into active strategies? We have to make sure we remain attractive. The good news about alternative assets, things like real estate, things like private credit, the two asset classes he called out specifically, you can't really do them passively. They have to be active strategies. So you can charge a bigger fee for those.
Okay, bigger fees. Excellent. Danny, thank you very much. Bloomberg's Danny Berger with the latest on that bond market story around Allianz and specifically PIMCO. Let's just get to where we are on the year-to-date story then, Tom. Halfway through 2023, seems hard to believe, but that's where we are. In terms of year-to-date gains then, we've seen the FTSE 100 really underperform, up by 0.6%. The CAC and the DAX both up 14%, 15% respectively.
Look at the laggard. I mean, the dividend play is something that people tout when they look at the FTSE 100 with their international exposure, of course, but the energy component and the cyclical component hasn't played out. Just going to 0.6% year to date. And there's the standout in terms of the DAX and the CAC, both up 13%, 15%.
Basic resources, the worst performing sector. So with that being the case, that explains a lot about the London market, doesn't it? That is it for this edition of Markets Today, and indeed for the programme for this week. You can get insights from us and the team on the front page of the Bloomberg UK website by typing TLIV Go on the terminal. This is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
This is Bloomberg.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. Happy Friday. I'm Francine Lacqua here in London with the conversations that matter. Now, here's what's coming up on today's program. French CPI follows Italy and Spain to a 14-month low as the ECB steps out its battle to ease price pressures. Euro area and key U.S. inflation figures also hit today. Strong U.S. data prompt traders to bet on 2 more Fed rate hikes this year. Now, UK house prices fall the most since 2009 amid soaring mortgage rates, compounding concerns from data showing living standards continue to decline. Now, first thing is first, so let's check on the markets. Actually, we're seeing quite a lot of stabilization, a lot more stabilization, certainly, than we saw the bond market repricing yesterday. The focus firmly on inflation. We did have a bit of encouraging news out of France. There's now a belief that maybe the ECB's monetary policy tightening has started to work. European stocks, you can see, gaining some 0.6%, 0.1% gain for the S&P futures. We'll have quite a lot of data, of course, from the U.S. The U.S. 10-year, 2-year yield, actually, the one that moved the most yesterday. I don't think we'd seen these levels since March of this year. And then finally, sterling 126.40. We really had a big week, not only when it comes to inflation, or inflation reading, but we heard from the Bank of England. We also have house prices today. Let's also look at the European map. Now, there's not a huge difference between Germany and the UK and the CAC 40. Over in France, we look, of course, at the riots. We had some better than expected inflation figures, but then we look at GDP forecast because of the riots. And then we have this fantastic story, actually, on the Bloomberg terminal, now looking at the fact that Russia is 1.5, or actually has like huge cargoes in terms of wheat. So they're really trying to consolidate market share for that. And of course, that means more security concerns over the war in Ukraine. Now, loads of European economic data today. UK final first quarter GDP rising 0.2% year on year, showing living standards are under pressure as incomes fail to keep pace with inflation. We also had that French inflation drop this morning following Italy and Spain. France CPI slowing to its lowest level in more than a year. And then Euro area headline inflation due at 10 a.m. UK time. So joining us now is Bloomberg's Opinions, Marcus Ashworth, and Barclays Global Head of FX Research, Themos Fiotakis. So thank you both for joining us. Themos, when you look at actually some of the inflation concern, is the market finally realizing that central banks will stop at nothing to make sure that inflation is at 2%?
Right here and right now, this is, I think, the main conversation. But I do think that from a thematic perspective, from where you put your money in, from a forward-looking perspective, this was actually the right time to position for that was 3 months ago when we actually argued that in our outlook. When you look ahead, you need to focus on the fact that in a widening number of countries, across a broadening number of indicators, inflation is losing momentum, and it's losing momentum in a more dispersed and more sure fashion than it was before. So I think that 3 months ahead, the market will try for the first time to really consolidate the peak in central banking efforts. And at the moment, even the US, which is having sort of like the most robust kind of data prints, is coming to price a level of rates which was in our forecast and was well above market expectations, but is now almost fully priced. So I think we are close to a peak in that sentiment, which you described.
Marcus, do you agree with that? Are we? How's monetary policy right now? Is it just right, or is it still too low?
Oh, I do agree with that very much. That's a very concise and clear view. I clearly think the Sintra Forum showed that whilst everyone was trying to keep the optionality of September alive, and I think some people are happy saying they will hike again in September. Clearly, July they are going to hike. There is definitely real concern that the economy is weakening. However, the message, which as you alluded to, is that even if they do cause, well, I think Europe already is in recession, but it will worsen. But by the time it comes September, maybe there'll be some clear evidence, as your colleague there is saying, that the inflation is dropping across a wide range of different measures and money supply and bank lending, that they can possibly hold off. But with the Fed being so, should we say, aggressive in their rhetoric, the markets are being talked into thinking that this is going to carry on and rates are going to keep on going higher. And I think positioning-wise, we are close or around, certainly fully priced into all these expectations.
So, Themos, it was clear to me in Sintra that Christine Lagarde and others kept on saying, come what may. So are they not ready to put these economies in a recession? And actually, what they worry about in the economy, it feels like it's really lending. So maybe they worry about some kind of credit crunch event down the road.
I think that there's already, and our European economics team has shown this, there's already an impact from rates tightening. And it is, even in Europe, even in the US, it's happening earlier than most past relationships would expect. For instance, in 2006, a lot of central bank peaked rates 1 or 2 years before the actual economic downturn started. We have started to see a slowdown in lending conditions already as soon as central banks raised rates close to or slightly above neutral a few months ago. So the impact is happening. In some places, particularly the smaller economies, it's happening a lot faster, but it's happening everywhere. And I think that the main problem that policymakers have, as was said before, is more the signaling and the uncertainty on the pass-through between growth, lending, and inflation. But I think that a lot of that is very backward-looking. We're all, as economists, trained to think about the forward indicators. And I worry a little bit that the focus on a lot of the backward-looking indicators like labor markets or spot inflation might actually lead to a confusing summer for markets.
Yeah, and I wonder whether we underestimate, Marcus, the fact that if they don't get inflation at 2%, it's also the credibility of the central bank, so they may over-tighten just to prove a point. Let me bring you also to my morning must-read. Now, there are three morning must-reads. Marcus, of course, Themos, and then John Authers, who basically in this piece writes, look, for the time being, however, investors don't seem to think that these higher rates will inflict an economic downturn. One explanation, John argues, would be that the economy's resilience. A perhaps more plausible one is that investors still don't buy that Fed policy is that restrictive. Marcus, is it actually not that restrictive given the wall of cash that we saw over the last 10 years? The real rates.
Wow, interesting view from John. I'm not sure I totally agree with that, but I mean, I think it is pretty restrictive, and clearly, certainly on rhetoric, Powell is making sure that he's worked very carefully and cleverly, perhaps, that any expectation of imminent rate cuts this year or even early next year, they priced out. So that in itself is even more restrictive. We don't talk about quantitative tightening very much, but that's running off at close to 100 billion per month. There's been lots of cash flows in and out with the Treasury General account and reverse repo things, but at some point that will bite hard as well. So I think the market is aware that the Fed had a lag effect, particularly on quantitative tightening, and equally that there will be more lag effect coming from the rate rises, which 500 basis points in a year. So I mean, I do think that the market is expecting. It's just I think everyone's surprised at the strength of the economy, in particular the labour market. So I'm not quite sure how to answer that one, but that's not. I don't see that people think that the Fed's not being restrictive enough.
Yeah, do you think, there could be some truth in that, actually, Themos, just because if you look at the real rates, I mean, they're nowhere as restrictive as actually, they could be?
I have 3 points to make to that. The first one is that if you look at any ex-ante measure of where policy rates should be for this cycle, Most of these studies we've done pointed towards 3 or slightly above 3. The fact, you can say that there's a margin of error to that, but the fact that we are above 5 and then the market expects a level of rates shy of 6, it definitely tells you that we have raised rates beyond the margin of error. Number 2, if you look at transmission mechanism, you have seen a pretty quick transmission from policy rates into market rates, into mortgage rates, and into also mortgage demand. So I think that monetary policy is working. Number 3, if you look at markets, at no point over the last few quarters has the market questioned the terminal landing neutral rate, the expected inflation, even in the US. 5-year expected nominal and inflation rates are pretty steady. The market addresses this as a mini cycle or a mega cycle, or what you call it, but small in terms of timing, but very aggressive in terms of magnitude, ones that central banks need to manage. And in many ways, the very aggressive language was more appropriate at the time where central banks were very lagging that cycle, very much lagging that cycle. At the moment, they're ahead of the curve. So I think that looking ahead, we need to think about how they consolidate that rhetoric, particularly relative to what is priced today.
Themos, let me also get your thoughts on chips, because shares in ASML are down after the Netherlands published new export controls that will restrict the company's chip-making machines from being sent to China. Now, this new export control regulation will force ASML to apply for export licenses for shipment of some advanced deep ultraviolet lithography or DUV systems. Now, the Dutch government says the measures will come into effect in September. ASML says the measures won't have material impact on the outlook. But Themos, this is just one story of being more careful with, selling some of the things to China or importing, some things to China. Does that have an impact actually on renminbi or dollar?
So we've written on this exact topic, and I think that if you look at these measures in isolation, they give you a sense that they are very targeted towards a very specific group of categories of semiconductors that are very strategically important, and they're more restrictive towards the chips that would actually help China accelerate from here into certain strategic areas. So in many ways, it's a lot more like a missed potential as opposed to a hit today. But if you think about the trajectory, these things are happening more and more, and these things are happening in a more intense fashion. So it's definitely an effort to curb a certain sector and a certain growth rate in the Chinese economy. So in many ways, it is a negative for China. China is, however, changing its policies very aggressively in response to that to be a lot more self-reliant. I would note that.
All right, thank you both for joining us, Marcus Ashworth and Themos Fotakis. Stay with us after the break, so don't go anywhere. This is The Pulse.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. The moment news breaks, no one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
It is less certain that we need to keep hiking the policy interest rate in the immediate term, lest we risk tightening too much and draining too much momentum from the economy.
I want to continue to indicate my support for the work that the ECB are doing. I know that they are highly aware of the consequences of decisions that they make and factor that into the decision-making process. They have said they are going to be data dependent in the decisions that they're making, but the objective that they have, which is the need to get inflation down, for me is a priority that we all share.
Well, Atlanta Fed President Raphael Bostic and the Eurogroup President there, Pascal Donahue, talking to Bloomberg. Now we're back with Bloomberg Opinions, Marcus Ashworth and Themos Fiotakis from Barclays. Themos, give us your outlook. First of all, thank you both for sticking around, but give us your outlook for the UK economy. So we have, as always, a bit of good news, a bit of bad news, and then in the middle you have the Bank of England having to try and navigate through this. UK living standards are resuming a decline, and this is, of course, a fresh blow to the Prime Minister, but at the same time we have a Lloyd survey saying UK business confidence is rebounding. So what's the state of this economy?
I think that the economy is a lot more stable and a lot more uninterrupted in its growth and potential than a lot of the stories make it. I think the stories are a lot more volatile than the economy itself. Of course, if you look at it on an average basis, there's a squeeze in the average household in terms of living standards, but you have to keep in mind that when you have a very strong labor market, the benefits are broadening, so more and more people are getting better off. And in fact, this is one of the big items in the UK. Because of supply constraints that have come up, particularly post-Brexit, the labor market has been very tight. Wages have outperformed other regions. And despite the fact that the output hasn't increased as much, you have definitely seen a more inflationary output per unit produced. So overall, I think that what the market has actually interpreted as stagflation, as a cost of living crisis, is actually an economy that is operating well above capacity. And finally, the market has actually repriced that quite aggressively in rates. Now, whether it's pricing it 100% accurately or not, I tend to think that by now it's fully priced. So the risk is that we get one CPI or one data that is slightly softer, and the market removes a little bit of the tightening and weakens a little bit the pound. But generally speaking, I think the direction of travel has been suitable for what the economy is doing.
Marcus, what's your take? So the Bank of England last week was pretty decisive with 50 basis points, and frankly, it was probably the right thing to do. It had little other alternative given that inflation print. What does it do from now?
Well, I mean, Bailey was very careful, again, to make clear that he doesn't see August 3, that there is any expectation of what they may do. They will decide then and there, and bear in mind that will be a quarterly monetary policy review. I suspect, as Thomas has pointed, there will be certain things they can lean to by then. We know that the July inflation number should be a lot better, courtesy of electricity prices dropping out a bit further. So I just think everything has been delayed in the UK. It's the way we calculate the inflation data, the way we regulate our electricity market, and indeed the ONS doesn't recognise perhaps certain things which would be recognised in Europe, and likewise the way that governments have stepped in and, should we say, saved the consumer and added to their own debt, which we haven't done in that quite the same way in the UK, or certainly on a lag basis, it's creating some strange numbers. But the housing market is surprisingly robust still, and the labour market is strong. It's just a question of the economy is not really going anywhere. But I do think it's held up better than I think you'll start to see in Europe. The gap will widen between the UK and Europe as far as growth is concerned.
All right, thank you both, as always, for joining us. I hope next time we do it in person. Bloomberg Opinion's Marcus Ashworth, Barclays, the Global Head of FX Research, Themos Fiotakis, joining us. Wide-ranging conversation. Coming up, lots of UK data this morning. What does it really tell us about the nation's economy as it deals with sticky inflation? We discuss more on that next. This is The Pulse.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Conversations that matter and the insights you need. This is A Pulse. I'm Francine Lacqua here in London. And we've had lots of data out of the UK this morning, including GDP and house prices. The numbers come at a tricky time for the UK economy as the nation's central bank, of course, recently hiked rates more than expected, 50 basis points. A lot of economists say, look, they didn't have a choice really to do that if they want to curb inflation after a pretty ugly inflation print the 24 hours before that. Now, for more details, Lizzie Burton, our UK correspondent, joins us. First of all, Lizzie, I'm confused about house prices. I mean, are they up, are they down, or are they stagnant? Because different surveys tell us different things.
Well, the big picture Bloomberg Economics says is that this is the calm before the storm. The nationwide data that we saw today shows it's the biggest drop in house prices, or falling the most, since 2009. So this is a bad one. And we had the BOE mortgage approvals data yesterday. You saw people basically trying to pay their mortgages off early because they want to escape these jumbo hikes that are coming. So the big picture Bloomberg Economics says is that you're still going to see a house price correction coming. You mentioned that GDP data. It still is anemic. Yeah. So it's kind of mixed. It's not a recession, but it's nothing to write home about.
Yeah. And cost of living crisis, so that's getting worse, and that's a huge political hot potato for the Prime Minister.
Exactly, and you saw more about that in this GDP data. So the household income per head, disposable income per head, I should say, fell 0.9% when adjusted for inflation. So living standards falling. It is not what Rishi Sunak wants to be the backdrop for going into election, especially when it was one of his top 5 promises to grow the economy.
Yeah, I mean, out of the promises, and this is what we spoke about last time, I mean, they've also promised to have inflation. I don't know whether there's any fiscal, they're staying the plan, but how does a government do that without, are they working more with the Bank of England?
Yeah, I mean, that's a conversation that we've been having over the past week, and economists talking about it more and more. All of the options are politically unpalatable, and that's why you've seen the Chancellor talking to the regulators, the energy, the supermarkets, the banks regulators. He's criticised by the opposition for that being too soft. You know, the companies are kind of saying on the one hand they are not guilty of greedflation, but on the other hand telling shareholders, oh, our margins are healthy, invest in us. How can that be enough of an intervention from the government, as you say, when its top priority is to halve inflation by the end of the year? But it's not just those 5 priorities that are wreaking havoc for the Prime Minister this week. You've also had the Rwanda policy to send illegal immigrants there, ruled as unlawful.
Is that a huge setback, actually, for the government, or does it just make them look like they don't really know what they're doing?
It just makes the mood look worse, doesn't it? It is one of the top priorities in the sense that Rishi Sunak promised to stop the boats crossing the Channel. But then you've also had the Thames Water issue as well, potentially facing nationalisation, which comes back to the inflation issue. So they're all tied up together. A very difficult week for the Prime Minister.
Yeah, Thames Water, I know you covered it yesterday. We need to spend a bit more time on just looking at some of these companies that have so much debt out there and what that means in terms of refinancing. Lizzie, thanks so much as always. Lizzie Burden, our UK correspondent. Now, coming up, we speak exclusively to Benoit Bazin, the CEO of global construction firm Saint-Gobain, on everything from inflation to supply chain issues. That's coming up next, and this is The Pulse. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Can you believe it's summer already? That means it's time for the Boston Pops Fireworks Spectacular. And Bloomberg will make sure you see all the fireworks, music, and special appearances by pop superstars and Vogue, chart-topping country duo Low Cash, and film, TV, and Broadway powerhouse Mandy Gonzalez. Plus the U.S. Army Field Band and the cast of the Broadway musical Ragtime. It all starts July 4th at 8 p.m. Eastern, right here on Bloomberg Television and Radio.
Now, investigators have questioned one of Russia's top generals about the failed mutiny that presented the greatest challenge to President Vladimir Putin's quarter-century rule. Bloomberg has learned that Sergei Surovikin was quizzed about his links to Wagner mercenary leader Evgeny Prigozhin. Now, with President Putin's authority under attack last weekend, I look at the consequences this could have on stability inside the world's biggest nuclear power.
Over 24 hours, Russian President Vladimir Putin faced the biggest threat to his almost quarter-century rule. The uprising has raised questions about Putin's grip on power, the influence of hardliners, and their even more extreme view on the war in Ukraine.
This is probably the most overt display we've seen so far in terms of a public challenge to his authority. It must also have raised concerns about whether Putin had total control of his security services if this convoy was allowed to move again unhindered with speed towards Moscow.
I think there may have been an expectation that he would gain further support from Russian soldiers, and that maybe that this would spark protests in other Russian cities. And I think that may have played into the fact that he decided to turn back.
These events have thrown Russia's internal security into question, a worrying prospect for NATO given its nuclear arsenal. After 16 months with little success on the battlefield, and now a Ukrainian counteroffensive followed by the mutiny of his own forces, Putin's future may be in doubt.
You can imagine there'll be lots of conversations going on behind the scenes amongst the elite in the business and the military establishment about whether to continue to support Vladimir Putin into re-election next year.
Well, many people think that this is good for Ukraine's counteroffensive, that it shows a sign of weakness. There have been some reports that Ukrainian forces have made incremental territorial gains, but it's really unclear at this point. The alternative view is that actually, because of the weakness and the turmoil in Russia, that the Russian Defense Ministry and the Kremlin will decide to strike back even harder and do something out of the ordinary to distract from the domestic political struggles.
Well, to watch the full report, go to Bloomberg Quick Take on Bloomberg.com and Bloomberg on YouTube. Now let's get more with Peter Ricketts. Lord Ricketts, he was Britain's first national security advisor, former permanent undersecretary at the Foreign and Commonwealth Office, and former UK ambassador to France. So, Lord Ricketts, thank you for joining us. It was a pretty incredible 7 days, how fast this happened and then how fast it unraveled. How weakened is Vladimir Putin now?
Well, I think it has definitely weakened him. As you say, nobody had been expecting this kind of open challenge to Putin, who has been a pretty effective authoritarian ruler in terms of ensuring no threats to his own position domestically. His tactic was divide and rule among his subordinates, and that seems to have gone far too far in the case of Prigozhin. He was left with far too much room to maneuver, to the point where he was actually open to challenge openly the Russian military generals. So it's a sign of weakness. Putin had to turn to Lukashenko, the president of Belarus, to get him out of the fix and get rid of Prigozhin into Belarus. My own feeling is the Russian elite were very concerned that Prigozhin was channeling the anger of many rank-and-file military at the obvious failures of the Russian campaign, and that therefore it would have been dangerous to take him on. So that is all a sign of weakness. Now, I'm not suggesting that Putin is going to fall imminently, but I think his grip on power has been weakened. The sense of invulnerability around him has been badly tarnished, and therefore those who have ambitions for the future must be beginning to think, how can we manage this transition? How can I secure my own safety as the purges come, as they are almost bound to do?
So, Lord Ricketts, how quickly could Vladimir Putin go? And is there an obvious heir?
I mean, I don't think anybody can predict that. We didn't predict this sudden Wagner eruption into the Russian domestic space. And Putin will be doing everything possible now to weed out those who may be plotting against him. I think the disappearance of this General Surovikin is related to the fact that he was close to Wagner. He was the link man between the Russian General Staff and the Wagner Group, and so therefore he's now under questioning. And anybody who's had any links with Prigozhin and his operation will now be worried. So, I mean, it still could be a matter of years, but it feels to me like we are now in the end game of the Putin regime.
Does Vladimir Putin become more dangerous in this end game?
Well, he's been pretty dangerous up to now. I mean, he's been cracking down on dissidents and opponents within Russia for at least a decade. He's been throwing everything he can at the war in Ukraine. So I don't really buy the thesis that things could now get worse for Ukraine because Putin will feel the need to lash out. He's been lashing out for over a year. I think this has to be good news for the Ukrainian offensive. To have all this going on behind the backs of the Russian generals and the Russian forces must be destabilizing for them. Wagner themselves have been pulled out of the Ukraine battle. They were some of the most effective Russian troops. They were so brutal that they perhaps had better effect than many others. So all this, I think, weakens the Russian defensive operations. The issue always is timescale. And with an authoritarian dictator like Putin, I don't think we outside can ever know when the decisive moment will come, because if we knew, he would know and he'd do something to fix it. It will come as a surprise when it comes, but I think we are now in that period.
So, Lord Ricketts, how difficult is it to understand the level of morale in the Russian army right now?
It is difficult because, of course, news is very controlled. I think there are people who follow the Russian military bloggers and some of the postings of the Russian rank and file. And there's clearly been an enormous amount of frustration with the conduct of the war. And that's what Prigozhin was tuning into, that sense that the generals have messed up, that a lot of young Russians have died, but absolutely no gain at all in Ukraine. How far that spreads into the broader population, I mean, we just don't know. I suspect most Russians try to stay as well clear as possible of anything political for fear of their own safety. But I think there's probably an underlying anger at the failures and the humiliation of the Russian forces in Ukraine, because that's what it's been, which will play out in due course.
But Lord Ricketts, can you say with confidence that actually Prigozhin, did a U-turn because he did not get enough support from the generals, or was there really a deal struck?
It's mysterious, isn't it? My feeling was that it was all quite impetuous. I think Prohodkin was furious when the decision was taken to demand that Wagner effectively wrap themselves into the Russian armed forces, and that the Wagner forces signed contracts to become part of the Russian armed forces. He saw that as a threat to his lifeline, his funding, his support from the Russian MOD, and decided to act. And it was an extraordinary gamble that he took. The fact that he had such an easy time of it at Rostov-on-Don, where he was able to effectively occupy the Russian command post, suggests that there was a degree of complicity among local forces. I think he probably got to the point where he was massively exposed halfway to Moscow, miles from his own bases, and Lukashenko or somebody said to him, look, chum, either you come to Belarus or it's the end of you. And he decided that discretion was the better part of valor.
Really extraordinary insight from you, Peter Ricketts. Thank you so much for joining us, former UK National Security Advisor and former UK Ambassador to France. Coming up, China and the war in Ukraine are on the agenda as EU leaders meet in Brussels. So we're live in Brussels next. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Now, the conversations that matter and the insights you need. This is The Pulse with me, Francine Lacqua, here in London. Now, EU leaders have started talks on the final day of a summit in Brussels after agreeing on future security commitments for Ukraine. Switching from the war to economic security, EU leaders will also focus on China today. Now, for more, our correspondent on the ground, Maria Today, who's been following the meeting, of course, for us and all of these stories from the very beginning. So, Maria, Ukraine aspires for NATO membership. Will it actually get it?
Yes, Francine, absolutely. And this is the fundamental cornerstone of their foreign policy. They continue to say there is no better deterrence against Russia than NATO membership. And yesterday night, Francine, in a meeting which ended in a very European way at 1:30 in the morning, European leaders again repeated, yes, we stand with Ukraine, but also went a step further and now point to future security commitments. The issue, however, Francine, is that the framework is not clear. And when it comes to the NATO question, it's also not clear because the Ukrainians obviously know they will not join as the war is going on. NATO also has a very heavy internal debate as to what kind of security guarantees they can provide. And also all of this will lead to the real meeting and the tension point here, which is the NATO summit in Vilnius. Will there be consensus? Will they promise Ukraine, yes, you will join, not now, but after the war? That is exactly what the Ukrainians will want. That is still a question that is very much up in the air. And frankly, there's quite a lot of fear still around this idea of Ukraine and NATO for a lot of member states too here.
Yeah, I'm sure there is. Leaders also debating the role of China today. So, Maria, how much will de-risking feature in these discussions?
Yes, and Francine, you see the common thread here from security in Russia to now economic security in China. And we know that von der Leyen, the head of the Commission, has been clear now in her proposal, no decouple, but yes to de-risking. And I asked Latvia's Prime Minister, Mr. Karins, what does that mean when it comes to European policy? And this is what he said. Let's take a look.
We've never really had a European China policy, but it's in the making. And the mantra is the de-risking, taking the lessons that we've learned rather painfully on our previous high energy dependence on Russia.
And that was Latvia's Prime Minister, Mr. Karins, again pointing to the idea that Russia does offer lessons about de-risking when it comes to crucial issues like security and energy. This conversation in China continues today. But again, one of the issues here is that they all say, yes, we agree with the idea of de-risking, but what does de-risking mean for every member state? And we know there's big differences of opinion among the EU. So today, again, expect a lively debate, hopefully not until 1 a.m. in the morning. We do want a weekend on Bloomberg, but expect this to be another heavy debate.
Yeah, Maria, thank you so much. Only Maria Tadeo can actually pull it off for us. So to bed at 2 a.m. and then up at 6 a.m. Up next, Bloomberg Surveillance Early Edition with Kriti Gupta in New York, Danny Berger in London. They'll have a full roundup of some of the news out today. We have a lot of U.S. data, and then we also have a bit of UK data at 10 a.m. What does this mean for central banks? We also look at bonds around the world, and this is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. China's economy continues to lose momentum. Manufacturing contracted again in June as calls grow for more policy support. In moments, we're going to get a fresh read on euro area inflation that may provide more clues on future ECB hawkishness. Key U.S. inflation data also hits today. And Nike drops its full-year outlook, and it failed to win over Wall Street. There's concerns about its high stockpiles. Happy Friday. Welcome to Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Kriti Gupta is in New York. Kriti, happy last trading day of the week, month, and quarter to you.
Right back at you. You know, what's interesting is we've been talking about rebalancing all week long, and it feels like now perhaps a little bit of positioning showing up for what that back half of the year is going to look like. The pre-market action, Danny, is pretty interesting stateside, especially when you look at the bond market. We're going to get to that in a moment, but let's look at NASDAQ futures first, because you are seeing a bit more momentum here. Green on the screen, higher by about 0.4%. A little bit of tech outperformance already, which is interesting because right off the bat, we have also gotten some news overnight about simply chip exports. So in theory, that should weigh on some of the big players, and yet it's not. NASDAQ futures, again, like I said, higher in the green. But again, this is going to come in a little bit of a low volume environment. Remember, we are headed for the 4th of July on Tuesday, so a lot of folks are taking the long weekend. Some have already left their trading desk. So really keep an eye on how much volume and liquidity plays a role, which brings me to the bond market, because again, those are common themes we're seeing there, but already a repricing happening there. A 2-year yield that's getting closer and closer to 5%, 4.92, already higher by about 6 basis points, almost 7. What's important is in the last 24 hours, Danny, you're starting to see the Fed swaps market price in 2 more rate hikes for the end of the year, even having major Wall Street houses like JP Morgan, for example, ditch their bullish Treasury calls. So you're seeing that kind of show up in the market action this morning. In theory, as yields go higher, the dollar should follow as well. But I would say today's market action for the greenback is really a function of the euro. I'll let you tackle that story, but right now the Bloomberg Dollar Index higher by 0.1%. And of course, we love to look at the commodity story. You are seeing a lot of green on the screen, except in gold. Gold now testing that 1900 level, down about 0.3%. What does that say about kind of the risk on, risk off narrative?
Kriti, some breaking news to bring you that you alluded to. Euro area June consumer prices have hit. They are higher by 5.5% year over year. That is less than the estimate of 5.6%. We've had an immediate reaction in the euro, that is to weaken versus the dollar. Now, stocks have mostly been unchanged on that news. That is, they are higher and they continue to move higher. Green everywhere throughout the regions. Kriti, you pointed this out to me this morning. FTSE MIB, it is now on track to close at its highest level since 2008. Some of those cyclical stocks that live in Italy, like banks, doing well. This has been a very good week for cyclical European stocks. Maybe, again, some quarter-end type movement. Let me take you into the cross-asset picture, because, again, it is in reaction to that euro area data we got. we're looking now to euro that is weaker versus the dollar by 0.2%. It was stronger before that data hit, an immediate plunge in terms of strength in the euro. Sterling, that's only slightly stronger versus the dollar, maybe unwinding some of the bearishness we had this week, but we had a whole bevy of UK data, everything from house prices, which maybe didn't fall enough, but just falling in general, showing concerns there. And then we also had GDP for the quarter, 0.1% is how much it grew. So European stocks hold up. And finally, that inflation data hasn't really changed the fact that we're selling bonds, which you might expect. But Kriti, it's very possible that the German bond market is basically just tracking the US in terms of that sell-off. So German 10-year yields, those are higher by about 3 basis points.
Yeah, certainly something we're going to be keeping an eye on both sides of the Atlantic. But let's go across the Pacific for a moment, Danny, because the one thing we haven't talked about at the start of the show is what's going on in China. China's economy lost even more steam in June. Manufacturing activity contracted again, and other sectors failed to build momentum. Joining us now is China economy and government editor Jill Deeses. Jill, what did we learn from the PMI survey we got about the state of the Chinese economy? Walk us through the data here.
Sure. Yeah, thanks, Kriti. So look, ultimately what we're seeing is this continued slowdown, this loss of economic momentum in China. There wasn't a ton of huge surprises from the data today, but ultimately we saw factory activity continuing to contract for a third straight month in June. That's never been an extremely strong indicator this year as the rebound has continued, but still some signs of trouble there. But then the other thing too is that while activity for the non-manufacturing gauge, this is the one that measures services activity and construction activity, did expand in June. It's ultimately not expanding at quite as strong of a pace as it was in May. And so that what that's telling us is that there's some indication that some of the rebound is losing a bit of momentum there. I will point out that in addition to that, there were some of the smaller sub-indexes that were quite interesting. We saw a bit of a pullback in employment in the services, non-manufacturing sectors there. I think that's a pretty big sign of concern for the Chinese economy because we've already seen some other indicators suggesting that youth unemployment, for example, is at record highs recently. That's kind of where if there's that pullback in hiring in the services sector, that's where you're going to see some of that reflected. And ultimately, if unemployment continues to be a problem, we can see that spill over into lack of household confidence, which has been perpetually this issue over the last several months. And then ultimately, that might translate into a further pullback in consumer spending. So all of these just combine to give you some further signs of weakness in the Chinese economy right now.
Jill, are these data points enough to push the PBOC, to push policymakers in China to have more stimulus, to do something that looks a little bit more shock and awe type levels of stimulus than what they've done so far?
Well, I don't think that we're going to see shock and awe type stimulus levels out of China right now. So what we've been so remember earlier this month, the PBOC did cut a key policy interest rate. We've been surveying some economists who say there might be one more of those maybe by the end of the year, though I think the median estimate has maybe a much smaller policy rate cut. What everybody's looking for, though, are other fiscal measures. If there's going to be anything bigger and more dramatic that could maybe boost the economy on a more holistic level. I think that that Beijing right now, though, has a lot of constraints that are facing policymakers. At this point, remember, local governments still have quite a lot of debt that they're reckoning with. There's all of these different things that kind of go into the calculus here for policymakers, and I think they're going to be quite constrained in the amount of stimulus that they deploy. We've been hearing that from quite a few economists. I will just point out as well, remember that target, that growth target for this year that policymakers set back in March, it's only around 5%, and I think the economy is still, there's a pretty low base of comparison with last year. The economy is still projected to grow well within that range, and so policymakers have been signaling for quite some time that whatever is coming in terms of policy might not be super big, but it's possible that we could see something in the coming days and weeks.
Jill, thank you very much. That's our China economy and government editor, Jill Deeses. Now, Nike shares are falling in the pre-market trade. The sportswear firm posted less than expected fourth quarter earnings per share and a disappointing outlook. Now, its sales beat forecasts, and analysts also highlighted Nike's better than anticipated performance in China as a bright spot. Joining us now is Bloomberg Consumer Goods reporter Dasha Afanasieva. Dasha, first off, with these numbers, what is the read across here to the broader consumer sector?
Well, I think what came across from the analyst call is that there are concerns about the strength of the consumer. So particularly, the CEO talked about a promotional marketplace in the context of the high inventory levels that you mentioned, and also talked about consumer weakness defining that as, part of the reason why they had this quite conservative estimate for the full year that the market didn't like.
Nike is such a fascinating story simply because of that exposure to China as well, which in some ways is kind of seen as that retail bellwether as well. But speaking of perhaps retail bellwethers with exposure to China, Shein considering an IPO in the U.S., it could be met with some pushback. Walk us through why it's so controversial.
Well, Shein is at the center of a number of different contentious issues, namely labor standards and accusations that it uses forced labor in its supply chain, which it denies. Bloomberg recently did a story about how traces of cotton found in Shein products and then imported in the US actually came from Xinjiang province that's accused of using forced labor. There's also the US-China trade dispute that's obviously relevant because the US is a big market. And more broadly, fast fashion and its impact on the environment, the impact of very, very cheap clothes that people buy in huge quantities and then end up in landfill.
Certainly something we're going to be keeping an eye on, of course, to see if those claims are even substantiated, given that the company has, of course, denied the IPO as well. Bloomberg's Dasha Afanasieva walking us through that story. Another major consumer story that we are watching this side of the Atlantic. As we head into the holiday weekend, well, airline delays still sticking around. JetBlue now joining United in blaming federal regulators for the worsening congestion that has left thousands of customers stranded. Joining us now is Bloomberg's Sid Phillip. He covers transportation and logistics around the world. Walk us through this story. This week has been really fascinating given kind of the fighting words between the FAA and United specifically.
Absolutely. So there's a lot of finger pointing as the airline industry braces for what's going to be a very busy flight weekend ahead of the Independence Day holidays. And the airlines have been blaming the regulators, saying that the regulators haven't staffed up air traffic control, and that's partly the reason for worsening congestion. The FAA has come back and said that essentially they're not responsible and weather has been responsible, and they've sort of pushed back on those sort of by the airlines' claims, saying that they're responsible for the delays and cancellations. But the net result is that people have been left stranded at the airports and there have been delays and cancellations.
I mean, there's been so much frustration everywhere, Sid. You know, the bullwhip effect of the pandemic, meaning we have these labor issues and just these general airport issues. Where's the light at the end of the tunnel? How does, again, it's not just an American problem. We feel it here in Europe and in London. How do we sort through this?
So it is a worldwide problem, and essentially the rapid rebound of aviation from the lows of the pandemic has come with loads and loads of problems, especially in terms of staffing for airlines, in terms of being able to sort of hire up and bring in people and train them. And I think that's a real concern for the industry as we get into a second summer after the sort of pandemic. And I think people will be looking to see if the airlines and the airports and others have actually made sort of good on those promises about staffing up, ramping up staffing throughout and preparing themselves for the busy period. And this is really the major test for the industry because it is a very busy weekend for travel in the US, and some of the airports like New York and Denver, where there have been issues, there will be some sort of looking at what's going on and whether or not the industry is ready for it.
Sid, thank you very much. That is Bloomberg's Sid Phillip. Now, coming up, EU Leaders Summit in Brussels is underway. We're going to bring you the latest next. And we're also going to wrap up the first half, look ahead to the second half. We're going to be doing that with Kevin Gordon, Charles Schwab, Senior Investment Strategist, later this hour. Plus, get ready for some technical analysis. We're going to be speaking to strategist Jay Woods of Freedom Capitals about the charts, about the lines on Bloomberg.
Everything you learn is additive every day, and if you keep at it and don't quit, It's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. The moment news breaks, no one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
We are focused on getting to a place in which we get inflation down and that we can still support growth within our economies. I'm confident that we are still able to do that, and that confidence is underpinned by the record levels of employment that we still have and by consumer sentiment that continues to be positive.
That was Eurogroup President Pascal Donohoe there speaking exclusively to Bloomberg's Maria Tadeo at the EU Leader Summit in Brussels. And let's get over to Maria. Maria, I want to talk about the Leader Summit, but first, you know we've got to talk about your first love. That is European eco data. We just had inflation numbers out a bit ago. We had core ticks up, lower than estimates, though. What do you make of it?
I thought Bloomberg was my first love, but beyond that, look, when you look at the numbers that we've seen, yes, there is a cooling down in inflation. We're seeing it in the euro area. We've seen it in some of the biggest economies. But to me, the fundamental question, and I don't think there's a clear answer on this yet, is this definitive proof, and this is what the European Central Bank wants to see, that inflation is now on a downwards trajectory that will be maintained across time so they're able to hit that 2% target. This is a single mandate central bank. They have to hit that target. Otherwise, their credibility will be heavily questioned. Now, we know that for July, there will be a rate hike. The question is, what about September? They have said, yeah, we stay persistent on inflation, but we also monitor the data. To me, now the real focus is what happens in September. Now, to look at the political side to this, we did hear this week from the Italian Prime Minister, Giorgia Meloni, who said the idea of just hiking is simplistic. It could actually be detrimental to growth and not really tame inflation. So there's a lot of play here, both for the central bank, but also for the elected officials.
Maria, I don't know what kind of economic indicator this is, but I feel like they just turned the lights off behind you. Luckily, you're still well lit, but maybe trying to save that energy bill with inflation where it's at. Okay, look, you're at the Leaders Summit, and of course, one of the big topics there is Ukraine. They aspire for NATO membership. Does it look like they're going to get it?
Look, this is such a crucial question. And as you know, for Ukraine, the cornerstone now of their foreign policy is to both enter the European Union and NATO. And they're very clear on this. In their perspective, in their eyes, the only deterrence that works is NATO membership. Now, yesterday, I should note that European leaders stayed until 1:30 a.m. in the morning debating about Ukraine, again, repeating this message of we stand with Ukraine, but also added now a step further, saying we will also contribute to future security commitments for the country. But again, this doesn't really address the issue of membership. And for that, we'll have to wait for the NATO summit that will happen in Vilnius. The Ukrainians want a clear line that says once the war is over, Ukraine will join NATO. Will they get that? Frankly, at this point, I don't think there's a consensus around it.
Well, Maria, speaking of the question of security, I want to go from Russia to China specifically. In the last 24 hours, we got new news about simply limits being put on the likes of ASML from the Dutch government about exporting to China. Put this into context of kind of the broader theme of how Europe is viewing China right now.
Look, and in fact, the two stories are heavily connected, because if you talk about Russia, you talk about security risk. When you talk about China now, for the Europeans, there is an element of economic risk. And today, in fact, I believe now as we speak, they have already started to debate the idea of China. And remember, the Commission, the head of the Commission, von der Leyen, she says no to decouple, but yes to de-risking. The question is, what does that mean? And that's exactly the question I put to Latvia's Prime Minister, Mr. Rakins. Let's have a look.
We've never really had a European China policy, but it's in the making. And the mantra is the de-risking, taking the lessons that we've learned rather painfully on our previous high energy dependence on Russia.
And that was Latvia's Prime Minister, again, repeating the idea that, yes, you should take lessons from Russia and apply it to China. The problem with the idea of de-risking, of course, is that it sounds great. The Europeans can agree to it. The Americans obviously love it. But what does that mean? I think when you look at the different member states, they have a different opinion as to how to treat China on the trade front.
Yeah, such a good point, that divide there. Maria, thank you so much, as always. That's Bloomberg's Maria Tadeo in Brussels. Now, Allianz plans to build out alternative asset classes. That's according to the CEO, Olivier Bäte. We're going to have more on his plan and what he told Bloomberg next. This is Bloomberg.
Covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology. And welcome to Balance of Power.
This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Climate is one thing that connects everybody across the globe. And if we don't do something about it, it brings down the value of all companies.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Now, some of our top corporate stories. Allianz plans to push deeper into alternative assets such as real estate. That's according to CEO Oliver Bete, who spoke in a wide-ranging interview with Bloomberg News. Now, he also said flows at PIMCO have stabilized, but are still shaky as investors assess the outlook for interest rates. PIMCO did manage to attract 14 billion euros in the first quarter after 4 quarters of outflows that Kriti totaled something like 75 billion euros. But it's interesting because it's not just the market action here. It's the fact that if I want to go out and buy a bond fund, I can just buy TLT, I can just buy a passive fund, I can buy something with low fees. I don't need to pay up for an actively managed fund. And PIMCO and Allianz's CEO, to some degree, realize that when the flows start coming back, it's not necessarily going to go to them.
Yeah, and I think the best way to kind of phrase that, perhaps a lack of incentive to really hop in the market in that way, is exactly what he said, referring to kind of the ability of the investment strategy to really beat the market. He said, look, there's just not any alpha left in a traditional treasury, and I think that's really important given it's not just about inflows and outflows. This is coming on the heels of them dealing with the banking turmoil and the kind of fallout of that, as well as a hedge fund blow up, which I think cost them something like $6 billion, Danny. So they're really struggling here to make that marginal dollar.
I will say they flagged real estate as one of the areas they want to go more into. I get it, you can charge higher fees, but they have defaulted on an office property in the US, so not all clear there. Kriti, we're also tracking Goldman Sachs. It's lost its ranking as the world's top M&A advisor for the first time in 5 years. Bloomberg data show that JP Morgan is now the top deal maker globally with a role in $284 billion of transactions. Goldman slid to second place, and $237 billion of deals is where they stand. Bankers are facing one of the worst periods for M&A in the last decade, with global deal volumes falling 42% this year. So, Kriti, I wonder if Goldman can just kind of brush this off and say, okay, this market is weird. When deals come back, so will we.
Yeah, it's interesting that this is coming in the M&A ranking, because if you look at kind of what Goldman really specializes in, they also had a really big stake in the IPO market specifically. And now with the IPO market kind of drying up, the M&A space isn't giving them that tailwind to perhaps make it up. So let's see if they recover perhaps in the back half of the year, but perhaps no surprise that JP Morgan is back on top, especially given they're on top of trading revenue as well.
Yeah, certainly. All right, Kriti, coming up, we're going to get back to the market story and what we're expecting for the second half of the year. We're going to be speaking to Kevin Gordon, Charles Schwab, Senior Investment Strategist, next. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. China's economy continues to lose momentum. Manufacturing contracted again in June as calls grow for more policy support. In Europe, Euro area core inflation re-accelerated in June, a setback for the ECB that may reinforce its determination to raise interest rates next month. We get key U.S. inflation data as well at 8:30 a.m. Eastern Time. And on the corporate front, Nike drops as its full-year outlook failed to win over Wall Street analysts. There is concern about those high stockpiles. We'll dive into it. I'm Kriti Gupta in New York with Danny Berger in London. Danny, a lot to digest here, but I gotta say, I feel like the bond market is taking the cake when we're talking about repricing and really perhaps that sensitivity to the inflation data we're getting on both sides of the Atlantic.
Yeah, I mean, that bond market sell-off yesterday, Kriti, it was steep, it was violent. It also comes off the back of the biggest net long, according to JP Morgan's survey, of treasuries since 2010. So the positioning, the pain trade clearly was yields up, price down. And that's the action we continue to see in Europe. In Germany, yields are higher by 2 basis points when it comes to the 10-year yield. Elsewhere, I gotta say, it is remarkable to see how strong risk has been behaving this week here at the end of the month, the end of the quarter. It's a really strong session thus far for European equities. The FTSE MIB on track to end at its highest since 2008. And it's cyclicals that are getting us there nonetheless. Now, there's not clear evidence, perhaps, that we're heading towards anything like a recession in Europe. Inflation data, though, we did get that about 30 minutes ago. Consumer prices rose about 5.5% for the euro area year over year. The estimate was for 5.6%. So it is lower than estimates, but let's be honest, that is still too sticky for the ECB. Regardless, euro moves lower, weakens versus the dollar. Sterling, though, just ever so slightly higher, Kriti, but it's had a very, very bad week with that strength coming from the dollar.
I love that you mentioned the cyclical trade here because I have to say it's not something we're seeing, that leadership, it's not something we're seeing stateside, but perhaps there is a theme, this idea of simply risk-taking, risk appetite, at least in today's trading session. I think a good way to look at that is through NASDAQ futures, higher by about 0.5%. But what's interesting is when we think NASDAQ futures, we think, okay, well, it's technology, it's a defensive play at the top of it. But remember, a lot of these big tech plays, especially after this kind of AI craze took over, have a lot of beta attached to them. So what's important to keep in mind is that perhaps that risk-taking that manifests in cyclicality in Europe is manifesting as kind of high beta moves in the NASDAQ story. We're going to get a little bit more insight in our next 2 interviews. But for now, take a look at the bond market. The 2-year yield at 4.91, already a move higher about 5 basis points. I think a continuation of some of that market action, Danny, that you were just talking about. But with those yields higher, the dollar follows as well, at least marginally. A lot of it is a function of what you're seeing in euro, that weakness that you are seeing on that side of the Atlantic. I think what's interesting, though, is that even though we are seeing this kind of risk-taking ability this morning, it's showing up in commodities as well, everywhere except for in gold. 1904 on the precious metal, down about 0.2%. What does that say about the bid for defensives, and how is that translating into the tech trade? Which brings me into a really fun chart. The idea here simply that this is going to be the best half for the NASDAQ 100 going all the way back to 1999. That could be a big concern for a lot of people who are saying, is this reminiscent of that kind of dot-com bubble? Others might say that actually this is really based and kind of driven by the fundamentals, by massive investment on the AI front. Let's see what our next guest has to say. A true expert, Bloomberg cross-asset reporter Denitsa Sakova joins us next. How does this kind of rally, this margin of rally, compare to what we might see in the back half of the year?
Yeah, so that chart is obviously incredible. If you look at, this is the best first half ever. But what is more incredible, if you look at where we started this year, this was the year with the most bearish forecast for the S&P 500 and US stocks in 2 decades. So we started from a place where the positioning was bearish, people were waiting for imminent recession, and the type of chart we're seeing now is not what people were expecting. Kind of the consensus was that bonds will outperform stocks, that US stocks are going to underperform international stocks. And we had a lot of the big banks saying that, you know, we may see the 2022 lows being retested in the first half of the year. Of course, now looking back, those things didn't materialize. But the important thing is we started from a very bearish place, which to many people is a good sign. It means that there is buying powder, and from all that bearishness, we can see a short squeeze, and that's what we saw from fast money traders. Another thing we saw is active managers were actually under position in mega cap. So what happened is they were also chasing the rally. So the question from here going forward is that all of that bearish ammunition exhausted, or is that the start of a strong momentum upwards for those assets?
Is it, Denitsa? What do strategists say? Is this the start of continued momentum?
Yeah, so what we're seeing is very interesting. It's kind of split in between. If we go back at the start of the year, everyone was bearish. Now we're seeing 2 camps. We're seeing a lot of big banks like Goldman Sachs upgrading their targets, and they're predicting significant upside for the S&P on the year. Like the consensus was the S&P was going to be flat, and now we're seeing people saying, oh, it may be up 70% on the year, which is obviously a big number. But then there is the other camp, which kind of plays with that thesis, which we've been talking all year about, delayed recession, you know, those intense rate hikes will take a very long time to trickle down to the economy. So that camp is keeping all their gloomy forecasts that, you know, there are so many things predicted, and they're just pushing them later on. So the good news about it is that there is still enough bearishness. So if we say that bearishness helped the rally, there is still enough of it. But the question is obviously how far can it go?
Denitsa, thank you so much. Denitsa Tekova there from our markets team. Let's get more into the markets conversation. Kevin Gordon, Senior Investment Strategist at Charles Schwab, joins us now. Kevin, thanks so much. Great to have you in the studio this morning.
To see you.
Look, so many people got this year wrong. So many people got last year, the year before. Basically, it's been a spat of having a very difficult time in this market. For the second half of this year, how much conviction do you have on where we head from here?
You know, I think in general it's a low conviction environment, and you know it's just tough because we're still dealing with so many vagaries around COVID. But when you talk about risks and you think about one half versus or first half versus second half, I think what's going to be interesting is this widening out, or the widening out we're waiting and broadening out in breadth for the market. And up until maybe a month ago, it was the case where you had pretty narrow leadership, widely advertised, only a few handful of stocks that were driving the rally. That started to change a little bit in June, and in our mind, we would get a lot more constructive if you continue to see that. So more participation down the cap spectrum from cyclicals. I think one of the areas you're seeing it the most is in industrials, but something that maybe has the potential to kind of sap that, I think, would be any downturn in earnings. So if you don't get any uptick, because at this point, multiple expansion has basically been driving everything since October. You haven't yet seen a positive contribution from forward earnings. If you get that, I think that's a really bullish scenario. But if you don't get that and you sort of stall out, I think that's a potential risk that's kind of looming, especially because you're now 8 months, more than 8 months off of the low in October.
Right.
Anytime after that, you need to start to see earnings kick in.
Well, the macro data has been strong, especially in the U.S. Does that give you hope that we do see something beyond multiple expansion, that these companies are going to actually start turning out very strong earnings?
I think that's the bullish case, and especially when you think about small caps, which haven't been participating as much, the macro data improving, that's the best case scenario for them. The obvious catch with that, and we'll find out today with the PCE data for the Fed for inflation, if inflation catches up in conjunction with that, I think the Fed would view that as an issue. So I don't think that this Fed right now is battling financial conditions like they were last year, and we got evidence of that from Powell's words words a couple of days ago in Sintra, but I do think that's a building risk as well, where you might have a little bit more hostility if inflation takes much longer for them or to get to the goal that they're hoping for.
Well, Kevin, let's stick with the kind of pain trade, or perhaps what the Federal Reserve is going to do. Overnight, a 15 basis point move in the front end of the curve, at least stateside, we were looking at the 2-year yield, really pricing in 2 more rate hikes for the end of the year. Does that matter for a stock market? What's priced in here?
Well, you know, what's interesting is that the relationship between bond yields and stock prices has just grown less volatile, I would say less hostile versus last year. So I think that's a positive scenario. That's a little bit more of a positive backdrop. But, you know, our thinking hasn't been as much on the number of hikes or how many more we have left to get to the end terminal rate. It's much more about holding and how much the Fed and how long the Fed wants to hold there. So I think that's been more of the focus. And Powell successfully, I would argue, has been really trying to sort of price out rate cuts for the end of this year, which last time I checked the terminal, that was still the case. And then I think moving into the beginning of 2024, I think they really want to stay focused and get the markets focused at least on the fact that there's really not going to be any immediate pivot to rate cuts or rate easing, especially when you have the revision we had to first quarter GDP, the fact that the inflation metric that they track the most, the core ex-housing services component of PCE just isn't easing in any way, whether it's month over month or year over year that they would be hoping for.
Well, Kevin, let's talk then about how that does translate into the tech sector specifically. You mentioned the breadth rule and that you are starting to see that concentration expand out a little bit. But how do you view these tech stocks? Is it still a defensive trade given this kind of leaning towards kind of artificial intelligence and these other, I want to say, riskier investments and innovations? Or is this still kind of viewed as perhaps very exposed to business investment? What do you kind of classify tech as right now?
Well, you know, putting the AI trade aside, I guess for a sec, you know, that trade really started to, the tech trade really started to do well and outperform. I'll call it the large cap growth trade, started to do well when you started to see the banking stress and the implosion of SVB and Signature Bank. That drove this massive split between small caps and large caps, particularly up the quality spectrum. So in that sense, you know, the rally for tech hasn't been unjustified. I mean, directionally, I think that makes a lot of sense. And, you know, back in the pandemic shutdown days, you know, tech was basically the haven trade because those were the companies that we were living in and sort of relying on in that time. And it's not the case that we're not relying on them anymore. It's just less so. So I think that the share that they have of overall earnings, and you compare that to sort of their market share, that's grown a lot wider. And I don't think that, you know, that's the necessary reason where you have to have some convergence and they have to completely catch down. And so it makes sense from a quality perspective. But the way that we've been thinking about breadth in this rally is that when you go, you know, through these big cycles and you have major market lows like we did in October, at this point, and you can go back nearly 100 years in market data for this, you tend to see better participation. You have a lot more stocks in the S&P making a new 52-week high. You have a lot more trading above a 200-day moving average. Same thing when you broaden out to the Russell and then to the NYSE. So I think that's probably where I would find the most maybe risk moving forward is if you don't get that broadening out, because that to me would kind of result in a little bit more of a nasty convergence.
You know why I like this conversation, Kevin? Because there's too many doomers out there right now, and that has not played out. So it's nice to get some realism, a breath of fresh air. Kevin, thanks so much for joining this morning. So Kevin Gordon of Charles Schwab. Now, coming up, we're going to turn the conversation to technical analysis. We'll be speaking with Jay Woods, Freedom Capital Chief Global Strategist, who joins Kriti and me next. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Can you believe it's summer already? That means it's time for the Boston Pops Fireworks Spectacular. And Bloomberg will make sure you see all the fireworks, music, and special appearances by pop superstars En Vogue, chart-topping country duo Low Cash, and film, TV, and Broadway powerhouse Mandy Gonzalez. Plus the U.S. Army Field Band and the cast of the Broadway musical Ragtime. It all starts July 4th at 8 p.m. Eastern, right here on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. Look, it is the last day of the quarter, the month, the first half of the year. So how do you position for the back half when you have seen a lot of green on the screen in the S&P 500 specifically? For that, I want to bring in a true expert on the technicals, because the question here isn't the fundamentals necessarily. It's how do you navigate it, even in a time when perhaps more and more people are getting a little bit bearish. I want to bring in Jay Woods, Chief Global Strategist over at Freedom Capital Markets and a long-time broker at the New York Stock Exchange. So we like to bring you on for the nitty-gritty on stocks. All right, get ready, throw it at us. How do you play the S&P 500? Walk us through the technicals.
It's been a slow grind. It's been kind of boring, and bull markets tend to be boring, especially when you're coming out of, what was a pretty aggressive bear market. So it's been frustrating. You're not getting the volatility that we're used to. The 1% or more swings intraday aren't happening. This is good. It's been a very constructive rally to me. We broke above the August 2022 highs at 43.25, and we just tested them literally to the point, and we rallied. So I think we're going to see a lot of sideways action. The thing to me is the broadening of the rally, because too many people were focused on that Magnificent Seven, and we're seeing it. We're seeing it in the Russell finally catching up, having a great June, and a few other sectors that I like the industrials.
Can that get us to 4,500, Jay?
Yeah, I think 4,500 is a realistic target. It's not too far from where we are now. And, technically, the setups are there. Now, what can take us above 4,500? I don't see what that catalyst is going to be. But what I do like is the rotation we're seeing underneath the surface. And to me, it's constructive. But it could set up for another boring 3 to 6 months. There is really nothing that's going to move the needle. But to the downside, we do have some good support levels that I think should hold. We focused on 4,200 breaking above it for so long. That old resistance should be support when tested.
I mean, look, a boring market is wonderful, especially considering the volatility that we've seen. We all want boring, but I personally want the drama, Jay. I want the excitement. Talk to me about industrials. You mentioned it. Where is the excitement going to come from in this sector?
Well, that's where we're hoping it's going to come from. The industrials have been basing for quite some time. And what I look for, especially as a technician, are those long bases and something to change. And we look like we're on the verge of a breakout. What could that catalyst be? Right now, within the sector, the defensive stocks have been doing really well. You want to look at something like the ITA, the defense sector. But within both the defense sector and the industrials is a big down name called Boeing. Boeing has finally reversed, what was a really ugly downtrend for quite some time. It's basing again. It's making higher lows, which is very constructive. Once again, it is boring. I know you want action. As a trader on the floor for so many years, there's nothing better than a crazy day. But we need to build bases, have this constructive rally, which I think we're seeing. And if you're going to watch one stock that could break the industrials out, it's Boeing. If you look at that chart, long-term downtrend, trend has changed. So that's good. It stopped going down. As simple as that is, that's a positive sign. And now what has it done? It's taken a leg up, and it's consolidating here in this nice range. And it looks just like the industrial pattern itself. that it wants to break out, and it has a lot to reverse. So keep an eye on Boeing. That could be the tell for the industrial sector going forward.
So let's broaden this out again, because Boeing, as you mentioned, is not just a heavyweight in industrial and defense, it's a heavyweight in the benchmarks as well, the S&P 500 and the Dow as well. When it comes to today's trade specifically, it's the last day of the month, the quarter, the first half. Talk to us a little bit about what could kind of change today's trade. Things perhaps like the student loan forgiveness, SCOTUS decision. Is that going to have some sort of market read-through?
Well, today first the PCE. I think that, being the inflation gauge that the Fed likes to watch, that could move the needle if we get a surprise there. But yes, student loan debt has been the chatter on the floor. It's a chatter everywhere, actually, because it's going to affect a lot of people and how they spend. So we'll see what happens. We'll see how that affects discretionary spending going forward. So I think that could be one of the bigger stories going into the second half of the year. And then the other story I look for are some of the beaten down names. What were the leaders this year? 3 of the top 10 winners, we know all about AI, were the cruise lines. Well, those were the most beaten down sectors. They have a lot to reverse. I look for stocks that were beaten down. Yes, they may be up 50, 70%, but given the max drawdown that they had, there's still room to run. A stock like Generac is a stock that I follow that, yes, it's up 45% year to date, but it's still 35% lower than it was a year ago, 12 months ago. These are the things I'm liking to see, constructive turnarounds in a wide range of stocks.
Yeah, and I have to say all of them kind of volatility plays as well, or have been in the past 6 months or so. All right. Final word, this back half of the year, are the gains gonna stick? What do you think?
Yeah, I think the gains stick. Traditionally when you have a good first half, it's followed up by a strong second half. There aren't too many X factors. The Fed has telegraphed every move. We didn't really even blink when he says we may do 2 consecutive quarter-point rate hikes. So I am very optimistic that things will continue to be on the upward trajectory. I just don't see it running away. I don't see it, being too exciting, but I like to see more participation, and I think that trend will continue.
Jay, you're breaking my heart. I will, again, come back with us, come back with the drama, but hey, it's good news all around. Jay Wood there of Freedom Capital Markets, thank you so much for joining us. All right, coming up, a host of U.S. data in your daily brief. We're gonna get to that next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Let's get you set up for the rest of your day and take a look at what's ahead. It's the end of an era, everybody. LIBOR is going to have its last fixing at 6:55 a.m. Eastern Time. A decade in the making after a 50-year history. RIP LIBOR. We're also going to get a slew of U.S. data. That's going to start with PCE, deflator, the Fed's favorite measurement, and personal income and spending at 8:30 a.m. Eastern Time. UMich consumer sentiment. This is just the final reading, so we'll likely just get a confirmation of what we had earlier in the month. That will hit at 10 a.m. Eastern Time. Plus, we're going to get some consumer earnings. Those are going to continue with Constellation Brands reporting. Kriti, that will happen before the U.S. Open. What are you looking at ahead of the Open?
Well, we got to talk about some of the earnings that we got in the last 24 hours or so. Nike is at the top of that list, Danny. Essentially, we look at it not only because it's a major retailer stateside, but it also has that exposure to China as well. Shares down about 3.6%. They're saying, look, the inventory is still an issue. We're beating our sales. We're beating our forecast, but it is still not enough when it comes to our full-year outlook. So that stock definitely getting weighed down this morning, down about 3.6%. But speaking of getting weighed down, I want to talk about the chip sector a little bit because this has become a geopolitical story that's having a very real read-through into the markets. ASML, the Dutch equipment maker, down about 1.7% as the Dutch government says you can't export to China anymore. That is a big deal for a company like that. What's interesting, it's not having a read-through into the U.S.-based tech names, Micron Technology, NVIDIA, Intel, all higher on the day, Danny. And lastly, we should talk about travel as well, because if we're talking about things in the red, United Airlines has really been in the news. You're seeing the airlines broadly see some delays, and right now, not really able to hold their own when the rest of the market seems to be a little bit more optimistic.
See, this fascinates me because there have been plenty of issues here in London, not recently, but every now and then there's a strike at Heathrow. Sometimes you're traveling to France, there's air traffic control strikes there. Kriti, it is this global story of demand for travel post-COVID. And it's a problem, and it's also a problem if you want to travel at a reasonable rate. Everything is so expensive right now for flying, and it's hard to do.
It really is, and I think you have to kind of parse out how much of this is a post-COVID kind of hangover as opposed to some individual airline issues. Remember the Southwest chaos? How much of that are you seeing become a very specific airline issue as opposed to kind of some broader story?
All I'm saying is I'm trying to plan my summer holidays. I'm not trying to spend my life savings doing so. All right, that's it for Early Edition. Enjoy the rest of your Friday. Surveillance is ahead on Bloomberg.
Middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
I think the environment we are in should be that we have sticky core inflation.
That sticky inflation is still the main concern.
We do think that inflation will decelerate more meaningfully than the Fed is expecting.
Our base case is still that the Fed probably only has one more interest rate hike in their pocket.
What needs to happen is consumers need to feel that they might lose their jobs.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It's a Friday before the beginning of you, because she is front and center. Amy, let's get the promotion out right now. Top of the show this afternoon. Stay tuned for the real yield, because the real yield is the only thing that matters on this Friday morning. Katie, the real yield's breaking out to new inflation expectation highs.
I mean, if we look at the 5-year, we're above 2% on that real yield. You take a look at the 2-year, we're on 3%. Watch. I'm glad that you told me first thing this morning to look at the real yield, because you're right. I mean, they are absolutely rocketing higher.
Well, 1.68% on the 10-year real yield. That's up a solid 10 basis points. 1.58 blowing out to 1.68. And Katie, that takes us back to yesterday. I thought the team did great about the shock of Bill Dudley's essay framing out in this coming quarter, we need to look for a higher yield regime.
And he was almost immediately vindicated, because I think we got that essay at 6 a.m. and then 8:30 we got jobless claims, we got GDP, and that actually led J.P. Morgan to ditch their bullish Treasury view. So an immediate rethinking on the heels of that.
Keep this up. This is the quote we showed yesterday, folks, on radio. In sum, this suggests a 10-year Treasury note yield of 4.5%. The former head of the New York Fed does the Frank Fabozzi exercise on where yields are heading. That changes everyone out there. It changes global Wall Street, changes your mortgage, your rent, everything out there to get the higher regime. Where are we? June 30. Let's bring up the drawdown chart. We did this when nobody believed in this bull market. We are down, down, down. SPX down 8% from the record highs. Dow Jones now down 6%. NASDAQ, even with the move, NASDAQ down 10%. Katie, the NASDAQ led by that Apple $3 trillion. I mean, NASDAQ is up 20-some% off the bottom.
And that's pretty amazing that we're still 10% down from that all-time high. Really tells you how big that hole was for those big tech stocks. And a lot of that was predicated on the fact that you do have rates moving significantly higher. It seems like that's not necessarily a hurdle anymore.
Let's do the data check right now. Dive into it here. Katie's going to brief you on a huge economic Friday. Futures lift. There's no other way to put it. NASDAQ leading the way. Futures up 14, Dow futures up 72, and the VIX 13.44. You wonder if we get a 12 print today within the melt up that we see. 10-year yield 3.88%. Really, the yields bear a lot of scrutiny on a technical basis to see if we do get a breakout. Yields 210 spread really back to recent historic lows, negative 104 basis points. Oil with a bit of a lift. West Texas American oil above $70 a barrel. Dollar with some strength yesterday, euro 108.46. And Katie, into the brief here, let's brief that Governor Bailey's enjoying a weaker sterling, 126.36.
And we'll see how that whole board changes at 8:30 this morning. We do have a lot of eco data coming out, including PCE, of course, the Fed's preferred inflation measure. We're expecting a cooling across the board there. We also get personal income and spending numbers. And then at 10 a.m., you're going to get University of Michigan sentiment readings. I'm really interested to see the inflation expectations in that report. Definitely one to watch. Moving on, this is interesting. We're also on Supreme Court watch. Of course, we got the decision on affirmative action yesterday. We're awaiting a decision possibly today on the Biden administration's student loan cancellation plans. Of course, that potentially impacts 40 million people. So a lot of people keeping an eye out for that decision to come. And we are on Apple's $3 trillion watch. The number to watch is $190.80. If you look at where Apple is in pre-market trading, we're above that. So we're there. That would make Apple the first company to reach that $3 trillion market cap milestone. We'll see if that holds through to 4 p.m. today.
The next hour, we're going to touch on is Dan Ives scheduled to be with us. I believe we're not going to see Mr. Ives today. He's got a family matter, but the answer is Dan Ives modeling out $4 trillion. We'll talk about that in the next hour. Again, futures up 14. Part of the collective memory that John and I have about bulls and bears is people that are out, switch their mind, and get it right. One of those is Max Kettner, Chief Multi-Asset Strategist at HSBC. We joined him in London ages ago, and he said, you know what, up. We get a brief today from the gentleman who got this rally right. Max, give us a redo here. How have you recalibrated for Q3 of 2023?
Yeah, good morning, Tom. Not an awful lot, really, because from a fundamental perspective, I don't think an awful lot really has changed yet. When we look actually at the U.S. economy, I think particularly against initial expectations, the U.S. economy is just doing fine, right? The consumer is doing fine. The services sector is fine. Look at all the concerns we had around the housing sector, around commercial real estate. The reality is, I think you guys at Bloomberg are running one of those surprise indices about the U.S. housing and real estate activity, and that's on a 20-year high, right? So the U.S. economy is really doing fine. So quite frankly, I don't think those recession calls that we're still having for Q3 and Q4, and in particular for the U.S. economy, that these recession calls are really, really going to come to fruition. I really do think that those recession calls will continue to be misplaced. And if anything, the risk is that things are continuing to be much, much better than expected, and that we will have another sort of short-end rate repricing.
Max Kettner, fold in here the linkage of economics to the markets, which I'm going to take through nominal GDP. If we have a persistent inflation, or dare I say even a breakout higher in rates on a broad global basis, and if we get some form of real GDP like the surprise of America, does that provide persistency to corporate revenues forward?
Yeah, I think it does. When we look at earnings, actually at earnings growth over the last sort of 30, 40 years, you overlay that with things like headline inflation, you know, that usually does provide some tailwind, because as you said, right, this is the discussion that we should be focused on much, much more, rather than looking at, you know, credit crunches and commercial real estate and debt ceiling and, you know, in effect, really some sort of when is the recession finally going to hit? Instead of that, we should be talking much more about, well, do we really care right now about real GDP growth? Or as an investor, like you were saying, right, the connection to markets is real versus nominal. And in effect, really, we should be caring much, much more about nominal growth, nominal earnings, and they're growing just fine. And think about Q2, the Q2 reporting season that's going to start in a couple of weeks. Consensus expectations, again, are only for flat growth, Q2 over Q1. They are, you know, they've been massively downgraded for cyclical sectors, for sectors like consumer discretionary, energy, materials, even tech, right? Even the tech earnings expectations have been downgraded by more than 10% in the last 5 months. So I do struggle to see a big, big decline or a big, big downside surprise in earnings, particularly now in the Q2 reporting season.
Well, let's talk about the next half of the year that we're sailing into. I want to talk a little bit about the expectations for the relative asset classes. Of course, there was a lot of doom and gloom about the corporate earnings picture, and this was really supposed to be the year of the bond, the year of fixed income. It looks like it just turned into another year for equities, specifically another year for big tech. Is that the dynamic heading into the second half? Is that how we're going to end 2023?
I think, well, I'm going to give you the classic strategist answer, yes and no, and it depends. I think what it's going to be is, I think at the beginning of Q3, I think, Katie, you're correct. It's going to be more of the same, right? More sort of growthy, the kind of Goldilocks environment where we're in right now, because growth is fine. Inflation, headline inflation is still going down. So that's sort of really, really Goldilocksy. The problem, I think, will come in late summer and towards Q4 when we realize, look, inflation could, and particularly headline inflation in the US, could start to pick up again because some of those energy base effects will fade, right? They will converge to zero. So we're going to have a bit of a mechanical push higher for headline inflation again. And then, of course, the economy doing much, much better. And that, in my mind, really will then favor value over growth. So that will then really make a switch from those big tech names into the more value and short duration names towards the end of the summer and into the fall.
How do valuations factor into that call for this rally to broaden out outside of just, mega cap tech, which has absolutely been dominating?
The short answer is not at all, nothing, right? Valuations don't matter, right? They really, really don't matter to me at all in the short term. If we're talking about the next 7 to 10 years, they're the thing that should matter the most. If we're talking about the next 3 to 6 months, they are, quite frankly, a random number. If you look at, the explanatory power of both outright and absolute valuations of equities, and also relative valuations, things like equity risk premium, and the explanatory power with sort of 6 to 12 month performance, it is somewhere between 2 to 3%. So they don't really matter, right? So to me, the valuation side of things, they don't really matter. It's more the inflation and the rates trajectory, right? And particularly inflation, the sticky inflation part, that matters for the next 6 months.
The left tail outlier right now, and we covered this yesterday, Max Kettner, with an important essay by William Dudley, the former president of the New York Fed, who modeled out a 4.5% U.S. 10-year. But the thing that no one's predicting is a higher interest rate regime. That goes against Steve Major, that goes against David Bloom and a lot of the HSBC research heritage. Are you guys prepared for the possibility of higher interest rates?
Not quite yet, because I think we're still in this Goldilocks environment, right? Where, yields have sort of peaked from last year. I think it is really a risk for the second half. It's not a base case. It is a risk, though, not on the long end, more on the front end. Because let's remember that, futures are still pricing around 150 basis points of rate cuts between the end of this year and the end of next year. So it is really one of those risks, I think, that if the majority of those rate cuts will be sort of pushed into 2025, not saying that there won't be any rate cuts at all next year, but if the market temporarily shifts its expectations, from 2024 into 2025, that has massive, massive implications from an asset allocation perspective, because what we just talked about in that environment, if that tail risk, that left-hand side risk really does pan out, you really absolutely don't want to be in growth names. You want to be shifting into the value names, perhaps even into the cyclical value names, rather than really having the long duration and tech assets.
Max Kettner, thank you so much for the June 30 brief. Mr. Kettner is with HSBC. This is so interesting, Katie, the idea of the percentage of people that didn't participate in a 7 or 8 stock bull market. Some of them are up fractionally, and maybe if they're institutional, their customers, their clients are saying, their accounts are saying, okay, why don't we own Apple? I mean, I really wonder, are we getting almost an October, November window dressing here, folks? into Q3 from the institutional pressure of get our acts together after missing this mother of all 6-month bull markets.
Right, and then you're left chasing the rally. And it's really interesting to hear Max say that valuations in the short term, they don't matter to him. That's not what he's looking at, because if you think of the rallying cry of bears, sort of the touchstone, it's that, okay, all of these stocks, these 7, 8 stocks, they have to come down at some point if you just look at the valuations.
Well, they got to come down at some point as they do, but the other thing is we've talked over the last couple of days, folks, is the memory of how you construct a second leg of a bull market. The optimists clearly feel that. I'm not advocating that, but I would say, yeah, you come off the mat with all the emotion of OMG, October, up we go, and the now what is really front and center here is a gamble or a guesstimate into Labor Day.
But I really think what you brought up, the idea that maybe rates do need to be higher, perhaps structurally higher if we get structurally higher inflation, that is still very much a hurdle.
Katie Greifeld with us here, Lisa Bramos and John Farrell off their own assignment, as they say, into a long weekend. Program note, Monday, we're open. I didn't know I was coming in. I may have the flip-flops and the floaties on. Stay with us on a Friday. This is Bloomberg Surveillance.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. News breaks. No one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already. History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
Unfortunately, again, we still need a lot of support. This year, the Ukrainian budget is fully funded. We're discussing 2024 now, and that will require all of our friends and partners, including all G7 countries, to help us to go through 2024, regardless of where we are on the battlefield and how fast we will win.
The ambassador of Ukraine to the United States, managing the message forward here, of course, just in a week ago or so, the tumult, the shock we all had of the upset, the mutiny in Russia, and the ramifications of that, the odd rumors and all this week. We say good morning to all of you here on the final day of the second quarter of 2023. We've got some wonderful market guests coming up, trying to figure out the way forward in this bull market, what we see in bonds, currencies, and commodities as well. I should note oil 69.98 with a little bit of a lift this morning, and futures do what they've done, confound people from October. Right now we turn to Europe. We could spend an hour with Maria today or this morning in Brussels, but don't have that time. We have enough time, though, to address the fact, Maria, that if you come out of New York City in 3 airports, all points for tourists point to Paris. And the immense guilt that Americans have is that we visit 3 arrondissements, maybe 5 in Paris. Everything is wonderful until it's not. And right now across France, it is really ugly. This is not just about Paris, folks, with Mr. Macron moving home to begin to deal with these protests. Maria, brief us now on the urgency of Mr. Macron's weekend.
Well, very urgent, Tom, because he has decided not to do a press conference here in Brussels. Very unusual. Frankly, I cover him all the time, and I don't remember a press conference that was canceled in Brussels. We know he loves the international politics, but now he's decided it's time to focus on the situation that is going on in France. We know that there has been now 3 days of protests, at times violent. We know there was a shooting of a 17-year-old, and we should stress, in Europe, it is not usual to see the police that shoots to kill. So obviously every time that happens, there is major pushback. The issue for Emmanuel Macron is that he had promised to the French people that by the French National Day on July 14th, protests would be in the past and the country would be forward-looking to a bright future. At this point, he's going back to deal with streets that are burning. We're being told that this is the major concern for the president, that he has been on his phone for 48 hours and now decided, I can't stay in Brussels, I have to go back home.
The distance from Pont-Neuf out to Nanterre, one of the poorer parts of Paris where all this tension began, and maybe it's a part that Americans don't see, speaks to the conservative lift in Europe. We see it in Italy, Maria Tadeo. We see it across Eastern Europe. Has there been a new conservative surge in Germany, in Macron's France, and even for that matter in Northern Europe?
Look, he's hoping to avoid that, but there has been a shift in politics in Europe. You saw that play out in Italy, in Sweden, in Finland. You have an election coming up in Spain. The Conservatives are polling very well. And for Emmanuel Macron, frankly, it's difficult because on the one hand, he wants to be seen as someone that is capable of maintaining order, but at the same time, he's got to explain why a 17-year-old was shot in what seems to be very murky circumstances by a policeman. And Tom, a lot of this is also cultural. I really should stress, in Europe, this idea that the police will shoot to kill in an incident like this is just not standard. It is not the usual.
Well, Maria, let's go from Paris back to Brussels, where you are, where all 27 EU leaders agreed to offer future security commitments to Ukraine. Of course, that comes on the heels of last weekend when we saw that mutiny erupt in Russia. How does that impact these discussions? How does that impact potential further support to Ukraine?
Well, I would say not just 27, but actually 28, because Mr. Stoltenberg, the head of NATO, he was here yesterday. And by the way, it is now widely expected that he is going to be renewed as the head of NATO for another year. Remember, he was supposed to leave for the Norwegian Central Bank in 2022, but then the war broke out. The idea now is that he will be extended for another year. Look, I think the fundamental issue here is not so much Russia. They say this is an internal matter. They don't want to comment on the politics. It's about Ukraine and NATO. What the Ukrainians want is a very clear promise from NATO next month that when the war is over, they will join NATO. Is there consensus to get that kind of promise to say, yes, you will join? Frankly, at this point, no. And this is a very delicate topic, not just here in Europe, but also in the United States and across NATO.
Well, on that topic, Maria, I mean, what's the current thinking of the likelihood that they will get that commitment next month?
At this point, if I have to be very frank, I do not think there is consensus. There's a number of ideas that have been floated. President Macron himself, he said we could do something in between, where you have something like this Israeli model, where you promise weapons, guns, money, anything they need, but they don't or will not fall into the NATO umbrella, and that is Article 5. The issue here is that Ukrainians will insist, they want to see a promise now that when the war is over, they will join. They say they've fought for this, they've shed blood for this, and want to see that commitment now on paper.
Maria, I'm not being snarky here or snide, but in a general sense, did Mr. Lukashenko of Belarus, did he have a good week? I mean, did he Does he come out of the week and the tumult of everything and say, hey, I'm in a better position?
Look, I think that's an excellent question. I think that's actually the point this week in Europe. Everyone's been talking about Lukashenko. I remember at one point there was this idea that he was a puppet. This week we've seen that he is not a puppet. He's very able to get his interests on the table. And at this point, he's been able to say, I am in charge of the situation in Belarus. I handle Prigozhin, and Vladimir Putin, by the way, owes me a favor.
Maria Tadeo, thank you so much. In Brussels today, a lot going on in Europe, and of course, we'll continue to look at France, where this is France-wide. It's not just about Paris as well. Serious riots with many, many people injured. Again, Maria Tadeo in Brussels. I know our Caroline Conan in Paris following the story as well. We come back to the shock and awe of a bull market, and I really want to emphasize that the heritage of Bloomberg surveillance is try to remember people that actually get this right. And there's other names involved here. But Katie, I've called the low of October the Ralph Ancampora Ed Yardeni low. These are two people of a certain vintage who did not know in October that we would go up 23%, Standard & Poor's 500, off that low. But you got as a lesson say, okay, let's look back, and where did I get it wrong that I was stuck in triple leveraged all cash? The third week of October, and I didn't have the courage to see what was forward. I would suggest the major thing was the misguess on earnings and the resiliency.
I got to say, Tom, I talked to a lot of people who are still very much in cash, especially on a cross-asset sort of view, because that money in cash doesn't just belong to equities. And when I talk to a lot of credit folks, they say, I mean, even though you have some of the junkiest credits out there, the triple C's outperforming this year, they can't justify going into riskier parts of the market when you're getting 4.5%, 5% on cash.
Well, it's competing here. And again, we're back to, I saw some chart last night in the Zeitgeist of a one-year piece out and apply a new regime of dividend growth 1 year out, 2 years out, 3 years out, and all of a sudden they compete. And we'll see, again, going back to just values alone, you mentioned Apple earlier. Everybody, I'm the only one who doesn't own it. And the answer here is I got a 32 multiple on Apple trailing, and I got single-digit revenue growth, but I do have that massive profitability and free cash flow. Dividend growth only 7%, 5-year dividend growth.
And that's the conversation I want to have with a smart person. Do you have to reset valuations here? I mean, to your point, you look at Apple and you look at this balance sheet, you look at the cash flow. Do you just put aside those valuations?
You don't put them aside, but you rationalize it in a bull market and until there's a fever. And the question is there a bull market fever right now? Many of the optimists would say we're nowhere near that yet. It sounds like an end of the quarter conversation. That's what I'm having with Katie Greifeld. She's in for Lisa Abramowitz and John Farrell. Really interesting Friday. Stay with us on Higher Yields. This is Bloomberg Surveillance.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Bloomberg Surveillance, good morning, everyone. The end of the quarter. We stagger into the third quarter. Monday, program note, will be here. I'll be here. John Farrell will not be here. Lisa Abramowitz will not be here. Kate, are you going to be here?
I'm going to be here.
Okay, Katie Greifeld's going to be here. That's a good and beautiful thing. And, of course, it's a good thing because there's so much to talk about. There's so much that we've gotten wrong. Let's observe how much I've gotten wrong with a market check. We do that with a VIX, which screams bull market 13.43. To remind ourselves, let's call it 16 is normal, 20 is a little bit of angst, 30 is a Lehman low angst. A lot of fear out there, and the fear goes the other way right now to a quiescent 13.43 on the VIX. Futures up 16, Dow futures up 96. Katie, what do you see in the bond market?
In the bond market, you're looking at yields sharply higher. I mean,
sharply is the right word.
Sharply, to bring it back to that real yield that we were talking about. I mean, now, again, you're looking at the 5-year real yield above 2%. I believe that's the highest since about 2008.
We're going to have to see on that. And again, the dollar, stronger dollar yesterday was, I think, a lead note as well. Right now, we're going to recalibrate on the American economy. Katie, what do we have?
Well, we heard from Atlanta Fed President Raphael Bostic yesterday, reiterating his call for keeping rates steady. We also heard from Ian Shepherdson of Pantheon Macroeconomics weighing in on the Fed's path forward, writing, quote, "We think the Fed is done, but a further rate hike in July cannot be ruled out. Another big increase in payrolls will trigger a hike. Either way, we expect the data by September to signal clearly that further rate hikes are unnecessary," Tom.
We're going to have to see. Ian Shepherdson there, always writing brilliantly for Pantheon Economics, and I really want to say outstanding work on China as well. Ian Shepherdson, we're recalibrating right now. We did with a third look at first quarter GDP yesterday, which came in with that convenient 2% statistic. Are we going to get the third quarter wrong as well?
Well, probably. Not least because the statisticians at the BEA kind of get it wrong at the first go-around as well. I mean, remember, they take 3 stabs at each quarter, and then after that, they do annual benchmarks and revisions long into the future. So you never really know where you are in real time. That's one of the problems with tracking the economy. We all get very excited about these GDP data, but they're really just kind of the midpoint of quite a wide range. So for the second quarter, it looks to me like the first estimate of growth is going to be something close to where we were in Q1, but a lot of that's going to come from inventories, which won't last and probably will actually reverse. And I'm more concerned looking forward about some of the softness in final demand. You know, consumer discretionary spending looks like it's wobbling a little bit, and business capital intentions and inventory intentions have absolutely rolled over. So a mixed bag, but I think net, I'm not seeing a lot of sustainable strength in the economy right now.
The sustainable strength in the economy gets to the great missed call this year, which is on recession. You and I have always thought it's sort of a juvenile debate because you've got NBER, what James Paterba's doing, that definition, and this one, and maybe someone like Lawrence Summers has a different definition as well. Are we going to continue this silly game of recession guessing through the rest of the year?
Oh, no doubt. But it kind of misses the point, really, because does it matter if GDP growth is minus 0.5 or plus 0.3 or even minus 1 or plus 1, given that it's not measured to that degree of accuracy anyway? What really matters from the Fed's perspective is not the headline GDP numbers. It's what happens in the labor market and what happens to inflation. Now, unquestionably, the labor market has been stronger than I think pretty much anybody expected going back to the turn of the year. These payroll numbers have been kind of amazing. But I do think there's a little bit of fraying at the edges now. Clearly, the pace of layoffs is going up. You can see that in all the data. Challenger, WARN notices, jobless claims, all going up. And hiring intentions in most of the surveys are going down. Now, eventually, that has to hit the payroll numbers. We cannot just keep printing these enormous payroll numbers when indicators of both hiring and firing are going in the wrong direction. So I think we're going to have a very interesting summer. But my guess is that by the end of it, we'll be looking back and saying, things have softened materially, both on the labor market front and on the inflation front, and that sets up a collision with some of those more hawkish Fed members who I think are kind of missing the point of having done enough already.
Well, Ian, how linked are those two pillars of the economy, the labor market and inflation, and in what way is that relationship flowing?
Well, in the medium term, I'm kind of on board with the idea that we can't have sustained inflation at the target and sustained rapid wage growth. It's just not plausible to think that wages could carry on rising at 4 to 5% and inflation could run at 2%. So I do buy the idea that the Fed has to engineer a loosening of the labor market. But in the short term, inflation and the labor market numbers are not quite so closely connected. And in particular, the story that we're seeing about margin compression, which is very clear in the producer price numbers, not so much in the CPI yet. But that story is independent of what happens in the labor market in the short term. And so is a pass-through from falling oil prices, falling food prices globally, the downshift that we're finally seeing in the rate of rent increases. All these things are pretty much baked in, regardless of how long it takes the Fed to slow down wage growth. But I got to say, looking at the survey evidence, wage growth to me is likely to slow down as well. So I've got a fairly bullish forecast for inflation, especially in the fourth quarter and into next year. And I just hope that the Fed is patient enough to wait to see this stuff coming through, rather than continuing to hike using backward-looking inflation numbers as a guide to forward-looking policy decisions.
Well, Ian, on that note, you wrote that you expect that both headline and core inflation will fall faster than the Fed expects. What's going to drive that, though? Is that wage growth slowing down that you talked about, or another factor?
Well, it's partly that. I do think the wage growth will be slower. I mean, I have to believe it when employers tell me that wage growth will be materially slower by the end of the year. You can see that clearly in the surveys. So I do buy that story. I also think the unemployment rate is going to go up a bit as well, and that will do some work as well. But margin compression still has a long, long way to run. So we've seen roughly a 25% increase in retailer and wholesaler gross markups during the pandemic. Now, that's peaked. It hasn't yet come down, so the rate of change has dropped pretty much to zero, but it needs to go negative. And all the things which signaled that margins were going to expand, like the huge increase in spending on goods during the pandemic and all those supply chain problems, they've all reversed. So I think it's just a matter of time before that stuff works through and pushes those margins back down and pushes down inflation in the goods sector, and the labor market should fix the services sector. So yeah, net, I'm pretty bullish that we are way past the worst of inflation, and there's some good news coming.
Ian, you've done brilliant on China. I remember the LinkedIn articles of years ago, and what Pantheon Macroeconomics has done has just been outstanding. Can you give me some optimism on China for the second half of 2023?
Yeah, I'd like to, but it's quite hard. I mean, we've seen the policy response from the authorities to the failure to launch that everybody was hoping for, after the end of the zero COVID restrictions. But the fact is that, Chinese consumers, have picked up some of the baton, but the industrial sector is still pretty soft. PPI inflation is negative and probably going to go more negative, which is good for the rest of the world. It means cheaper goods prices. But the momentum in growth that I think we were all hoping to see really isn't there. Still big problems in the property market, big problems in the whole industrial economy, and it's probably going to require more policy action, more stimulus, fiscal stimulus, and probably more monetary stimulus going into Q2. They really need to hit that about 5% GDP target, and that probably requires more action. But I'm afraid that the great hopes that we all had that China would be, really leading a global recovery, we're just not seeing it in China. We're not seeing it in the rest of Asia. That pull-through just isn't happening.
Fold that into a dollar call here with your U.S. view, with some of the struggles on margins, with what you see in China. Again, looking back the 6 months, a huge body of people got the weak dollar call wrong. Where do you see dollar at the end of this year?
I can see it moderating a bit. You know, I do have a less aggressive call on the Fed than the market. And, you know, clearly the ECB is going to hike at least twice. Bank of England is going to hike at least twice. I really hope the Fed doesn't. So given that that's now pretty much priced in that the Fed does go twice, that probably puts a bit of a negative spin on the dollar. But I don't think that's going to be a huge story. I'm not expecting any sort of seismic shift in developed market currencies either way over the next few months. But at the margin, I'd have thought the dollar by the end of the year will be a bit softer.
Ian, I actually want to go back to China and talk a little bit more about the idea that we could see stimulus, because we're having a conversation with Leland Miller later in this program, of course, of the China Beige Book. He says that it's sort of a fake out to expect a massive stimulus package. When you think about the support that China could unleash, I mean, put that in context. What kind of magnitude are we talking about?
It's not going to be very big. I mean, I just don't really detect any great appetite for any sort of large-scale fiscal stimulus. It's much more likely to be targeted to specific sectors and to specific regions rather than a sort of a broad free-for-all, you know, handing checks in the mail to Chinese citizens. They're very unkeen on that sort of policy approach. And their monetary approach is pretty incrementalist as well. You know, the last easing was all of 10 basis points. So I think there's a reluctance to go hell for leather. I think that they're more in a case of we'll do a bit and wait and see. And if we have to do a bit more later, then we'll do that as well. But we're not going to see some sort of blowout deal. I think they're very nervous about just throwing good money after bad, and they want to see organic growth developing. So yes, they will help at the margins, and they'll provide targeted support in some sectors, but we're not going to see a great blowout.
If you extrapolate that out, what does that mean for the rest of emerging markets? Because, okay, maybe the China rebound story, the reopening didn't exactly play out to some of the bullish, really, fantasies that we saw at the beginning of the year for emerging markets. But does the emerging markets bloc as a whole need a really strongly rebounding China to do well here?
Well, it's better for them for sure. I mean, it benefits the East Asian economies just through the trade flows. And you can see that one of the characteristics of China's failure to launch is the weakness of trade across the whole region. But of course, other EMs are further away, especially in Latin America, are very contingent on what China does because of the commodity story. You know, the copper, oil, and other commodity prices are very driven by China at the margin. So for those economies in LATAM, it would be very helpful if China were to gather a bit of momentum. So yes, I mean, it's been disappointing for all EM for different reasons, depending where you look. But moving into next year, if China can develop a bit more momentum, then that would be an uplift of the whole Asia and LATAM space. But again, right now, this is not something I think you can rely on happening in the next few months. It's going to be much more of a grind.
Ian, what we see in the next few months, I'm absolutely thunderstruck at the number of people trying to buy victory in Premier League soccer, in Premier League football in England. Is Newcastle United, your beloved Newcastle United, are they going to climb on board and start bidding $100 gazillion for all these fancy talents?
Well, the transfer season's in full swing now. We've just bought Italy's midfield captain, so yeah, the money is flowing. Of course, what happens is the Premier League is now just a plaything for very rich states, and so the days of local businessmen owning football clubs are long gone, and now it's just a race for the petrodollars. It's all sort of faintly absurd and rather disconcerting.
But it was fun to watch Newcastle United this year and to learn about the Shepherdson past. Ian Shepherdson with Newcastle United and Pantheon Macroeconomics with us today. And it just really, it speaks, Katie, we're making jokes here about English football because I miss John Farrow. I'm gonna tear up here. I miss Farrow so much.
I wish I had anything to add on soccer.
What the hell is it about these British people where they take like 3-4 weeks?
God bless.
Vacation.
He deserves it.
We're nuts. I mean, we're working Monday. What's that about?
I'm psyched too. That's
You're psyched. Yeah, I'm psyched too. But you look at this, and it speaks to the resiliency. And this is the heart of the matter, folks. And really, one of the great essays of the second quarter was Lawrence McDonald writing it out. Go to his site, Bear Trap, whatever it is. But Larry McDonald absolutely nailed the first order condition, which is just the mass of money that's out there. That's the number one thing we forget about.
I know, and you can see that. I mean, again, it's not just necessarily a U.S. story. Of course, we have our own fiscal situation, but then you look at some of the data that we got out of Europe this morning in terms of Eurozone inflation. Core inflation for a lot of these developed economies, it's still very much a problem. Consumers are still spending. We're still strong.
This is the tension, folks, and this is what we're going to be covering here into July. It's a late jobs report for June. Usually it'd be like July 2, 3, 4, a holiday gets in the way. July 7. Maybe John's coming back for 4th of July because he doesn't celebrate it. But, you know, you get to July 7 for the jobs report and then on to the earnings season. And the backdrop of this, which is, to me, the elephant in the June 30th room, and I'll go through the yields right now. 4.91% on the 2-year yield. Do we go back to a 5% there? It looks likely up 5 basis points. 3.87% on the 10-year, 3.92% a 30-year bond. Are you getting used to a 7.25, 7.5, dare I say 7.9% 30-year mortgage? Stay with us. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
We're anticipating the price to rise from here for oil in particular. By the end of the year, we're anticipating balance to go back into deficit again, and we're anticipating price to go up. Our forecast right now for June of 2024, a year from now, is $87 for Brent and $84 for WTI.
Darwin Kung, very intelligent at DWS there on the larger macro picture of what we see in commodities. We're going to get to oil in a business, but as we recalibrate here in equities, bonds, currencies, commodities, I've given, I would say, short shrift to commodities here through the year. And Katie Greifeld, it's just real simple. China, copper, commodities weaker. I mean, that's the summary. There's no other way to put it.
Commodities weaker, but then you look at oil, and I mean, that's the big head scratcher. I don't know if this is a supply-driven market, a demand-driven market, but it seems like it's going nowhere, at least for the last couple of days.
We'll have to see here with oil. It is a big. Well, the bull market's a big shock of the first 6 months, but oil's right behind there as well. Brent crude 74.34. We've not made a dash under 70 on world oil. But on American oil, decidedly, we have $69.72 with a visit to $66 a barrel. Everyone I speak to, led by John Tucker of Bloomberg Radio, makes clear to me that the price of gasoline has not followed a barrel of gas down. Maybe that waits for the third quarter to see a gallon of gas migrate down. providing immense service to us on the microeconomics of supply-demand of hydrocarbons has been Amrita Sen, co-founder and director of research at Energy Aspects. How do you recalibrate for the second half of the year, Amrita?
It's a great question, Tom, and I think the challenge we have right now, like you were saying as well, is that it's a bit of a bifurcated market, right? Crude has not performed as we've expected as well, but products markets have. And this is where I go back to, this isn't a demand problem. If demand was weak, we wouldn't have gasoline prices at the pump not having come down. Gasoline has actually done very, very well, including in China. Even diesel, where manufacturing has been weak, has actually started to perform very well. Overall, demand is actually holding up, and demand has been coming in stronger than we've been expecting, as you and I have discussed as well. There has been this issue with destocking, as we've talked about before as well. High interest rates just mean across the board, any business, they just don't want to hold as much inventory. So we've had more crude come to the market as a result of that. But also, I think supply. I do think Iran was the big miss we had. We've actually raised Iranian production now. They've managed to increase production. And, you know, the interesting thing about the Iranian situation is that if the same volume of oil, say, came out of the United States or Saudi Arabia, it would actually be less bearish. But Iran discounts its oil to sell, right? So that brings the marginal price down, and the availability of these discounted crudes, be it Iran, Russia, I think that's been the big story. Volumetrically, I don't think we've gotten balances wrong, but I think that the availability of more discounted oil has meant that prices haven't reacted in the same way.
Amrita, you and I have a shared respect for Edward Morse at Citigroup, who really looks at the geopolitics of hydrocarbons 24/7. And as you know, Ed Morse absolutely nailed the idea no oil wouldn't go to 120 and stay there, that we would visit 70, or dare I say $60 a barrel. Give us your geopolitical spectrum right now. What is the optionality Saudi Arabia has to raise oil $10 a barrel?
I mean, right now, given also the macro environment, I'm not expecting a lot or optionality, even from a Saudi point of view, to be able to raise production, because Saudi Arabia has unilaterally cut production. OPEC Plus have extended their voluntary cuts. There's not much more they can do. For them, it is about providing stability to the market, provide a floor so that even when there's a lot of demand uncertainty, you still have some continued investment. The market is tightening. You can start to see it in the heavier sour crudes, not in the lighter crudes. And this gets very, very technical. But we have a problem with naphtha. The petrochemical sector is actually very weak, and that is, like you said at the start, it's a China problem. The property sector is very weak. And the issue we have is all our benchmarks, Brent, WTI, are light crudes which have a lot of naphtha cuts in it. So it's a problem for the market, because we look at these benchmarks to give us signals of tightness, but you can finally start to see some of this tightness come through in the heavier sour crudes, like in Dubai. So again, the Saudi cuts, the OPEC cuts are working, but I still think it's going to take a long time, or a while, not a long time, but at least a few more weeks before we see that tightness percolate through the rest of the complex.
Well, I want to talk a little bit more about the different cross currents of the supply picture that you walked through a little bit. Of course, you do have the Iranian cut or production coming up, but you also have the OPEC cuts as well. When you balance it out, I mean, what's the bigger force here?
The bigger force, of course, are the OPEC cuts, and Saudi Arabia's unilateral 1 million barrels per day cut for July. Those numbers are a lot bigger. But that's why I mentioned that even if Iranian production, let's say on average, is up about 300,000 more than what we had expected, the fact that they are discounting their oil, let's say by $15, $20, $30, whatever that number is, that makes a big difference, because suddenly then Asia, which is your marginal buyer, doesn't have to buy benchmark crudes, right? It can buy cheaper Iranian, Russian barrels. And that's what's weighing on prices.
And if we talk specifically about the price action, you look at Brent, I think the low was around $70. You look at crude specifically, the low was around $64 set in May. Is that the bottom here, or do we have the potential to see actually that level break over the next few months?
My worry for the next few weeks is that we know always this is the time when sovereign hedges happen, particularly from Mexico. That's no secret, and it's thin liquidity. People haven't done very well this year because oil's been range bound at best, but a lot of volatility within that. So most people, most traders I know are like, okay, we're going on holiday. We'll come back and reassess. If you get these big sovereign hedges come through, you are going to get price pressure in the coming weeks, and that could mean in a low liquidity scenario potentially lower prices. But other than that, other than kind of flow-driven events, I do think the floor for Brent is, say, call it around 70, 71, and the upside should be in the mid-80s. So that's the thing I'm watching for in the coming weeks, is those hedges being put through.
Amrita Sen, thank you so much. Just huge help here for the first half of 2023. Really looking forward to speaking to her on the mystery of hydrocarbon forward. And I'll say this, folks, which I think is widely understood on Wall Street, it's the single toughest thing to predict. Amrita Sen and her ilk have the toughest job out there. I think the only research piece, Katie, I have on my coffee table at home in the living room is the J.P. Morgan 80-page piece modeling out $120 a barrel because of emerging market demand. Forget about ESG and the rest of it. Emerging market needs hydrocarbon, and up we go. Have they been wrong? Yes, but give it some time. And that's sort of the hope and prayer out there for higher oil.
Maybe you can lend me that book, because it's definitely a mystery to me. And then you look at the price action just over the past few months. I was reading a story this morning, Brent oil on track for its worst run of quarterly losses and data going back to more than 3 decades. This oil market has been so difficult to read.
And you take Saudi Light as an older series and you adjust it for inflation and you adjust it for our rising incomes. And it's amazing how it's not an oil depression, that's too strong, but it's really been quite weak. Well, we haven't seen that, looking at second quarter, Q1, going back to the Greifeld low in Bitcoin. What was the low in Bitcoin here? Do you take it off 26,000? Or do you where in your head do you say at 30,000 we're up X? I mean, how do you do that in
At 30,000, I say, holy moly, we're up a lot since we were below $20,000. That was, of course, in October. Everything rebounded in October. Bitcoin was no exception there. We're still hanging tough above 30,000. We saw that big move over the past 2 weeks. I don't know what the next catalyst, though, is.
So the fancy names out there, the people that crypto worships, the twins, what's their name?
The Winklevoss twins.
Yeah, and Novogratz and the rest of them. All the usual names of people out there that have been big on BitDog. Have they been made whole by the move up in Bitcoin? Or are they like, come on, let's get to 40,000? I mean, what's that mood right now?
It certainly helps, but I mean, if you think about the fact that you need to draw in some of the retail players that got really crushed from that move to $69,000 per coin all the way back down below 20,000. I mean, that's really extinguished a lot of just retail interest in the space. You're left with sort of these long-term believers. So if you think about what's going to propel the next wave of excitement here, I mean, you really need to bring in that marginal buyer who right now still, you look at the trading volume, it doesn't seem like there's a lot of interest.
How do you look at Bitcoin doing so well in some of our reporting today as other coins underperformed?
It's the haven currency of the cryptocurrency industry.
You're killing me. she's laughing at. You don't see this. I mean, the Bramo cam is still on, even though Lisa's not here. Greifeld has the Bramo cam on her, and she's laughing at me, folks. Over you don't understand, you idiot. It's just BitDog.
The haven currency.
BitDog is the haven currency. That's what I learned. Save me.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Climate is one thing that connects everybody across the globe. And if we don't do something about it, it brings down the value of all companies.
With sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
Can you believe it's summer already? That means it's time for the Boston Pops Fireworks Spectacular, and Bloomberg will make sure you see all the fireworks, music, and special appearances by pop superstars and Vogue, chart-topping country duo Low Cash, and film, TV, and Broadway powerhouse Mandy Gonzalez, plus the U.S. Army Field Band and the